Investing, you're choosing to stand still while everyone else runs. And standing still long enough means you'll eventually be left behind, quietly but surely. Picture yourself in a financial race. You're pedaling on a bicycle of saving, while others are riding investment rockets. No matter how hard you try, you won't catch up. Because the issue isn't effort, it's the tool you're using. The truth needs to be said clearly. Saving won't make you poor, but it won't make you rich either. It keeps you stuck in the middle. And if you want to break through, you have to change how you play, starting today. You can save your whole life, but if you don't understand inflation, you'll lose without realizing it. Inflation quietly erodes your purchasing power every day. A savings account with 0.5% interest can't keep up with the average 3% inflation rate. You think you're accumulating wealth, but in truth, you're falling behind. The value of money drops steadily, invisibly. The longer you hold on to cash without investing, the more ground you lose. Here's a simple example. If you keep $10,000 in a savings account, earning 0.5% interest, you make $50 in a year. But inflation takes away $250 in purchasing power. The result? You're actually down $200 without even noticing. Most people don't feel the loss until it's too late. Inflation is a silent thief. It steals from your future without ever stepping into your house. Saving was once considered a virtue. But in today's economy, saving without investing is stagnation disguised as security. What worked in the past may now be a trap. You're placing your future into a system you don't control. That makes you more vulnerable than ever. We can't beat inflation with savings. We can only beat it with growth. And growth requires investing. The lesson isn't to abandon saving, but to place it in the right role. Use it to build an emergency fund, 3 to 6 months of expenses. After that, put your money to work. Invest, learn, create new income streams. Don't let your money sleep in the bank. Wake it up and make it hustle for you. Because if you don't make your money work, you'll work for it forever. And that's not freedom. That's a trap. If saving helps you keep money, investing helps you grow it. Investing is no longer just for the wealthy elite. In the digital age, anyone can enter the market with a small amount of capital. Today, you can start with just $5, enough to buy into ETFs or fractional shares. What matters isn't how much you have, but whether you dare to begin. And let time become your greatest ally. Investing is the key that wealthy people have always held. Not because they're luckier, but because they understand the rules. They don't let money sit, they make it multiply. They leverage compound interest, what Einstein called the eighth wonder of the world. Every dollar reinvested earns more dollars, and those dollars earn again. It's a growth loop available to anyone willing to be patient and informed. The difference between the wealthy and the average isn't income, it's how they use money. The wealthy buy assets, things that generate income. The average spend or save. Assets include stocks, real estate, index funds, and businesses. When you invest, you stop trading time for money. You make money work for you, even while you sleep. That's the true game changer. If you still think investing is too risky, understand this. Not investing is the biggest risk of all. Because your money is losing value every day. Markets may fluctuate, but history shows that stocks average 7 to 8% annual returns even after crashes. What matters is starting early, investing consistently, and staying the course. No one gets rich keeping cash in a savings account, but many have built real wealth by investing at the right time. Relying on a single income stream is a recipe for financial fragility. One setback, like a job loss, a recession, or an unexpected emergency, can throw your entire life off balance. Wealthy people understand this deeply. They don't rely on one paycheck. They build multiple income sources, from investments, businesses, rentals, digital products, and more. Each stream acts as a layer of security. If one dries up, others keep flowing. That's not luck. That's intentional design. Diversified income is no longer a luxury. It's a necessity in the new economy. It's the difference between surviving and scaling. You don't need hundreds of thousands to begin. Start with what you already have, a skill you can monetize, a room you can rent, an idea you can turn into a product. Maybe it's teaching online, writing, photography, renting your space, or investing in dividend stocks. The point is not the size, it's the mindset. A side income today could become your main income tomorrow. The goal isn't more hours, it's smarter systems. Your future self will thank you for the courage to start small, because momentum doesn't require perfection. It just requires the first move. Imagine your financial life as a glass. If you pour water from one faucet, it fills slowly. But if you turn on 3 faucets at once, it fills faster, with less pressure on any single source. That's the power of multiple income streams. You don't need to work harder, you need to design smarter. Start with just one additional source, then expand. When you sleep, your system should still be running. That's how wealthy people build sustainable wealth. Not with endless hustle, but with strategy, flow, and vision. It starts with asking, what faucet can I turn on next? You can't build a solid financial skyscraper if your foundation is ignorance. Financial education isn't just for economics majors. It's a survival skill for anyone who wants to control their money instead of being controlled by it. Yet most people grow up never learning how to budget, manage debt, or invest. We're taught algebra, but not how to handle a credit card. And the result? Millions of highly capable professionals living paycheck to paycheck, not because they lack talent, but because they lack financial understanding. The truth is, knowledge isn't optional. It's essential. Financial education doesn't come from classrooms. It comes from choice. From deciding to read a book about money instead of scrolling endlessly online. From watching a video about ETFs instead of another distraction. Wealthy people don't know everything, but they know how to learn. They learn constantly. They learn from mistakes, from markets, and from mentors. And they know that investing in knowledge always pays the best interest, because it's the only asset that can't be taken away. Education is not a chore. It's the first dividend you collect on your future. If you think learning about money is boring, change your perspective. Think of money as the main character in your life story. When you understand how it works, you don't just control your wallet, you control your direction. Learning about taxes, compound interest, leverage, dividends, and assets won't just help you earn more, it'll help you keep more. You don't need to become a financial expert. You just need to become the financial leader of your own life. And that starts with curiosity and continues with commitment. The more you know, the more you grow. So where do you begin? Simple. Read one good money book, subscribe to a trusted finance channel, or join a free online course. Set aside 30 minutes a week. Take notes. Apply what you learn. Every insight is a brick in the foundation of your financial future. The more you study, the more confident you'll feel. Finances will stop being scary and start becoming your superpower. Because once you understand money, you no longer chase it. It starts chasing you. And that, right there, is when you take control of your wealth story for good. The financial journey doesn't start with money. It starts with mindset. Many people earn well yet live in fear of not having enough, trapped by limiting beliefs like, I'm not good with money, or wealth is for the lucky. But the truth is, mindset builds outcomes. Someone with a growth mindset always asks, how can I improve? Instead of avoiding financial challenges, they learn to navigate them. They succeed not because of their background, but because they believe in change. And belief is the seed of every transformation. Wealth begins in the mind, long before it appears in the bank. A wealth mindset isn't arrogance. It's choosing to view life through opportunity instead of fear. While someone with a fixed mindset blames the economy or their upbringing, someone with a wealth mindset finds a way forward. They don't ask, why don't I have money? They ask, how can I create it? They don't fear risk, they fear regret. And they know that mindset shapes decisions, while decisions shape results. It's not about pretending challenges don't exist. It's about refusing to be ruled by them. Wealthy people don't wait for ideal conditions. They create momentum, even in uncertainty. Picture yourself in a race carrying a backpack full of rocks. Those rocks are limiting beliefs, fears, and scarcity thinking. To move faster, you don't need more training. You need to unload the weight. Write down the beliefs holding you back. Replace them with better questions, clearer goals, and bolder actions. Shift one thought per day. Over time, you'll feel lighter, sharper, more in control. A wealth mindset doesn't come from your environment. It comes from the decision to think differently. And that single shift can change not just your income, but your entire direction. Many people believe building wealth requires a dramatic life overhaul. But in truth, Wealth begins with small actions repeated daily. No one becomes a millionaire overnight, but everyone can take consistent steps toward that future. You don't need to cut every expense. Just track where your money goes. You don't need thousands to invest. Just place your first trade. One small move today, if done consistently, can produce massive results 5 years from now. The goal isn't speed, it's sustainability. Wealth isn't built in leaps, it's built in layers, quiet, steady, intentional. Start where you are and let time magnify your effort. Think of growing wealth like planting a tree. You don't need to water it all day, just consistently at the right time. Finances work the same way. Set up auto transfers to savings or investments when you get paid. Make a debt repayment plan. Set a clear goal like save $5,000 in 12 months instead of vague wishes. Once your actions are specific, your brain engages and your habits stick. Success doesn't need to be complex, it needs to be consistent. Every habit you automate reduces the effort required tomorrow. Systems build discipline, and discipline over time builds financial freedom. Many people fail not because they lack money, but because they lack systems. When you turn finances into a routine, you stop relying on willpower. All you need is structure. Use a budgeting app. Review your finances weekly. Save a small amount monthly. Each habit is a brick in your financial foundation. Money doesn't grow by accident, but you can create the conditions for it to thrive. Combine small actions with enough time, and the results become exponential. This isn't about miracles, it's about momentum. Start now. Stay steady. Let the math, the habits, and the calendar do the rest. Saving helps you stay grounded, but it won't help you rise. True wealth comes from the right mindset, the right knowledge, and the right actions at the right time. Invest, create multiple income streams, educate yourself, and build automated systems. That's how sustainable wealth is built. Don't let time slip by in hesitation. Every day you act is a day your money begins working for you. Wealth isn't distant. It begins with one decision today. Start with what you have. Commit to progress. Because when your money works harder than you do, that's when financial freedom becomes your reality. The wealthy aren't luckier than you. They think differently, act strategically, and play the long game. In this video, you'll uncover 20 wealth principles that have helped billionaires not only rise to the top, but stay there when others fall. This is strategic thinking, personal discipline, and the art of building assets, influence, and legacy. Step by step, no fluff, no fantasy. If you're tired of chasing money and ready to master it, don't just watch. Commit. Internalize every principle here like your new compass. Let's begin at the root of every extraordinary journey. The mindset that dares to dream beyond all limitations. Think beyond limits. The power of unbounded vision. Ordinary people set goals to survive. Extraordinary people set goals that pull them out of their comfort zones. The bigger the dream, the stronger the drive. When a dream makes your heart race and your hands sweat, you're heading in the right direction. Not everyone dares to dream big, but only those who do can truly change the world. Don't shrink your ambition. Unleash it. Thinking beyond limits isn't blind optimism. It's asking, what would I do if I removed all the boundaries around me? When you ignore the walls that society or your past has built, you unlock a whole new map for action. Each step on that map may be difficult, but it will awaken the deepest layers of your potential. Believe that the extraordinary is possible, because that belief is the seed of every breakthrough. Big dreams make a difference, not because you'll always reach them, but because they change who you become. Each day, you'll behave like someone building something legendary. Every decision, from how you spend your time to how you handle setbacks, will shift. Remember, you don't need permission to dream big. You only need your own. When your vision expands, so does your ability to attract the right people, resources, and opportunities. Dreaming big is the very first lever in building lasting wealth. Failure isn't defeat, it's the tuition of the elite. High achievers don't fear failure, they use it as a learning weapon. Every stumble is a test of clarity and resilience. Failure doesn't mean you're not good enough, it means something needs to be done better. The faster you learn, the more strategic your missteps, the farther you go. No one reaches the top without scars. The question is, do you have the courage to stand up again? Failure is not a wall, it's a signpost. To extract value from failure, turn emotion into data. Don't ask, why am I not enough? Ask, what exactly needs adjusting in my approach? This shift in thinking fuels progress without destroying confidence. Everyone makes mistakes, but you can choose not to repeat them. It's not about how many times you fall. It's about how much you learn from each fall. The journey to success is paved with priceless lessons disguised as failures. The difference lies in the response. The weak give up when they fail. The strong restructure and return as better versions. Failure isn't just a lesson, it's fuel. It tests your resolve. If you treat it as a signal to quit, you stay stuck. If you see it as a launch pad, you rise higher. Learn to greet failure with strategic clarity, because no one wins without first walking through the fire. And those who succeed are simply better at failing forward. Networks are multipliers. Build the right ecosystem. No one succeeds alone. The people at the top build intentional ecosystems. Each quality relationship is a future channel for opportunities. Don't just meet people, seek alignment. One conversation with the right person can change your life's trajectory. Plant your network with sincerity, value, and consistency. Networking isn't a tactic, it's part of a larger success system. Your network doesn't just provide opportunity, it shapes your identity. The question isn't, who do you know, but who knows you and for what? Be the person who brings value first, opens doors, and builds trust. Every connection must be nurtured like an invisible asset. The right person at the right time is a lever money can't buy. Long game mindset. Patience is the ultimate power. Most people plan for next month. High performers plan for the next 30 years. Long-term thinking helps them see what others overlook. While others chase quick returns, they invest in deep, stable foundations. They understand that building something great takes time. Patience isn't just a virtue, it's a strategy. The longer the horizon, the fewer the competitors, and the greater the edge. Short-term thinkers act impulsively. Fast buys, panic sells, reactive moves. Long-term thinkers remain grounded and strategic. They don't abandon a vision because of a few shaky weeks. What others call crisis, they often see as recalibration. Volatility is noise. Strategy brings peace, and it's that stability that becomes a fortress during turbulent times. Real success comes to those who can embrace the boring. Fast wins may impress, but enduring wealth is built over decades. Long-game players aren't racing others. They're building something no one else is even thinking about. Sometimes, doing nothing is the most powerful move. They've created their own lane, and in that lane, they dominate, because they think further, see deeper, and act with deliberate patience. Lifelong learning. Knowledge is your edge. The world changes fast. What works today may fail tomorrow. Top performers never rest on past wins. They read, listen, study, adapt. They don't learn for fun, they learn to upgrade their decisions. Each insight is a puzzle piece that expands their strategic vision. Reading books, joining communities, and learning from the best isn't optional. It's a non-negotiable commitment to excellence. Learning isn't a hobby, it's leverage. You may not get rich by learning, but you will get left behind by not learning. Knowledge compounds like interest. The smarter you are, the more confident your choices. The more you know, the less you fear. And the less you fear, the faster you act. Daily learning is the quiet advantage of the wealthy. Time mastery. Do the right things at the right time with the right energy. Time isn't something to spend, it's an asset to be invested. High performers don't overload schedules, they ruthlessly filter what deserves attention. Every minute must produce value, either financial value or personal growth. They don't use time, they govern it. They treat hours like gold. You can lose money and earn it back, but wasted time is permanently gone. That's why the successful guard their calendars like fortresses. If you don't own your time, someone else will. Effective time strategy isn't about working faster, it's about choosing smarter. Elite performers begin their day with one question: what will move the needle most today? They plan by energy, not just tasks. Creative thinking goes in peak hours. Admin gets done later. They don't try to do everything. They build systems so the trivial handles itself. They aren't busy, they're precise. They don't sprint blindly, they move like chess masters, every move intentional and strategic. What you stop doing matters more than what you start. Masters of time say no without guilt. They delete distractions, automate repetition, and delegate wisely. They shape time into a directional force. Owning time isn't about doing more, it's about being in control. Real freedom isn't having free time, it's using time on your terms. Every moment without intention is a moment stolen from your future. And those who win long-term are those who learn to invest time like capital, deliberate, clear, and aligned. Discipline, the daily edge that compounds results. Discipline is the bridge between goals and results. Average people wait for motivation. High performers install systems that function with or without inspiration. They act not because they feel like it, but because they've committed. One small action, repeated with focus, outperforms scattered bursts of effort. Discipline doesn't make you robotic, it makes you reliable. Anyone who builds something lasting does it through disciplined execution, day in and day out. You don't need perfection, you need consistency. A tiny habit done daily beats a grand plan done occasionally. Discipline converts dreams into frameworks, and frameworks into measurable progress. Those who are disciplined don't need accountability. They are accountable to themselves. They don't argue with excuses. They silence them through action. And that repetition over time becomes character. If you want to create something remarkable, start by doing one valuable thing every day, without fail. Discipline is the multiplier of greatness. Emotional control. Stay calm when others break. Emotions are powerful, but uncontrolled emotions are dangerous. Average minds react. Exceptional ones respond with strategy. In chaos, the strong don't panic. They pause, they observe. They act only once the emotion has passed. One impulsive move can destroy years of strategy. Emotional control isn't suppression, it's leadership. When everyone else is screaming, the calmest mind holds the most power. Mastering emotions means treating them as signals, not instructions. High performers don't ignore anger or fear. They identify, label, and channel them. They understand that reacting to emotion creates regret, but responding with clarity creates control. The goal isn't to eliminate feeling, but to lead through it. The world rewards calm thinkers in storms, not loud reactors in crises. Stillness is a skill. In today's fast, noisy world, calm is a competitive advantage. Where others spiral, you stabilize. Where they quit, you adapt. Where they rant, you rethink. The one who controls their emotional state controls the outcome. You can't lead a business, a team, or a legacy without first leading yourself. Emotional discipline is more than a soft skill. It's a survival tool, a leadership core, and the foundation of your sharpest decisions. Value first, money follows. Money isn't the goal, it's the result. The wealthy don't chase cash, they chase contribution. The question isn't, how can I earn more? It's how can I serve better? Better products, deeper solutions, real impact. When you create genuine value, wealth becomes a byproduct. But if you chase only money, it will always stay ahead of you. Value draws money the way gravity draws objects. Focus on value, and money finds you. Creating value means delivering impact, not just effort. It's about solving problems, elevating others, and building something that matters. Quick profits fade, value compounds. The truly successful don't rely on gimmicks. They build trust, excellence, and depth. They ask, whose life improves because of what I do? When your answer becomes clear, so does your income. Root everything in value. Grow the tree. Let wealth be the fruit. Legacy. It's not about you, it's what you leave behind. True success doesn't stop at success. It evolves into legacy. Legacy isn't how much you leave in the bank. It's how many lives were better because you existed. It's not measured by titles or trophies, but by impact, by transformation, by inspiration. Real leaders ask, what will remain when I'm gone? The answer defines everything. Legacy is built through intentional action. It's in how you teach, lead, and lift others. Every decision today shapes your echo tomorrow. A kind act can ripple for years. A bold move can change generational cycles. The great don't wait for legacy. They build it quietly, persistently, every day. They don't need applause to do what's right. They're moved by vision, not validation. Don't wait until you're old to think about legacy. Start now, with one decision, one behavior, one habit that lasts. When you live for something bigger than yourself, energy becomes infinite. Impact becomes exponential. Wealth becomes meaningful. Legacy doesn't need to be grand, it needs to be real. Make your life echo beyond your lifetime. That's not just success, that's immortality through influence. In conclusion, wealth doesn't begin with your wallet. It begins with how you see the world and your role in it. The 20 principles you've just explored aren't shortcuts. They're foundations for a life of intention, growth, and impact. Each one is a thread in the fabric of lasting success. Apply just one, and you'll move forward. Apply them all, and you'll redefine your future. True wealth isn't just earned. It's constructed, protected, and multiplied through discipline, mindset, and purpose. Choose a principle to act on today. Your future self is already waiting. Stronger, wiser, freer. And the journey to that version of you starts now, with a single, intentional step forward. Money isn't just the result of income minus expenses. It's a refined narrative of how we think, feel, react, and live. In a world where assets are glorified, image is everything, and comparison becomes survival, there are silent but deeply vital truths about financial psychology. Truths no one teaches you, yet they shape your freedom or bondage for life. This video isn't just a summary. It's a deep, inspiring, and actionable journey. Get ready to shift your mindset to challenge everything you thought you knew about money. Because the real question isn't how much do I make, but what kind of life is my money building for me? Now, let's dive into 10 foundational principles. Psychology is the root of money. Money isn't the result of calculations. It's the reflection of fears, beliefs, hopes, and memories. When someone chooses to hoard cash, invest recklessly, or spend impulsively, it's not because they lack knowledge, it's because they're reacting to something in their past. Some people grew up with scarcity, so they become extreme savers. Others were raised in abundance and become fearless risk-takers. Every financial decision is rooted in personal experience. Understanding this is the first step to abandoning the habit of judging others. Instead of asking, why would they do that? Ask, what have they been through that made them act this way? When you look at people through the lens of empathy, you expand your own financial thinking. You learn more from their perspectives. You realize there is no universal formula for success. The wise don't copy financial strategies. They seek context, motivation, and values behind actions. From there, they choose an approach that fits their own life, not blindly follow someone else's advice. But most importantly, turn inward. Ask yourself, where do my financial habits come from? How can I better understand myself before I try to change? When you know the psychological roots of your behavior, you no longer panic during market downturns. You no longer feel shame when someone else earns more. You become calm, grounded, and intentional. Personal finance doesn't start with information. It starts with introspection. To master money, you must first master your mind. Compounding, the philosophy of the patient. Compounding is not just a financial concept, it's a universal law of growth, silent but unstoppable. In investing, compounding means earning interest on your interest, but in life it goes further. It shows up in learning, health, relationships, and character. Reading one page a day, saying one kind word each morning, exercising once a week, these are small drops, but over time they accumulate into oceans of transformation. The ones who win are not the ones who act big, but the ones who act consistently. The real challenge is that most people underestimate the power of small, repeated actions. They look for breakthroughs, desire quick results, and if nothing changes after a few days, they give up. But compounding doesn't reward the impatient. It rewards persistence. Like planting a seed, you don't expect fruit in a week. But with daily care, water, and sunlight, one day you have an entire garden. The patient planter always reaps a harvest. Compounding is the return on discipline. In finance, those who start early, no matter how little, will outperform those who start late with more. Time is the most powerful element in the compounding formula. Imagine investing small amounts regularly, starting at age 20. By 50, you haven't just built wealth. You've created a financial engine that runs on its own. Waiting until you're ready often means wasting the asset you can never buy back, time. Let time be your partner, not your opponent. But compounding works both ways. Negative habits, if repeated, also multiply. Each time you procrastinate, overspend, or say, "I'll fix it later," you're slowly drifting off course. Then one day, you wake up miles away from where you wanted to be. Compounding doesn't judge, it simply amplifies whatever you feed it. Choose your habits wisely. Repeat what's good, and you'll go further than expected. Repeat what's harmful, and you may end up rebuilding from scratch. Discipline now creates freedom later. Luck and risk, the uncontrollable variables. There's an often overlooked truth in every success story: the presence of luck. And likewise, failure doesn't always mean incompetence. Everyone walks a path filled with unseen forces, luck and risk, quietly shaping outcomes behind the scenes. Some are born in the right place at the right time and get access to the right opportunities. Others, despite being brilliant and hardworking, meet a single misfortune that changes everything. From the outside, we're quick to judge results, but beneath the surface lies the need for humility. In personal finance, the wise always make room for uncertainty. They never go all in on a single strategy. They understand that no result is guaranteed. That's why they build buffers, emergency funds, diversified portfolios, flexible lifestyles. When risk shows up, they're not shaken, and when luck appears, they accept it with gratitude, but don't become arrogant. Preparation doesn't eliminate chance, it respects it. It's the act of honoring the unpredictable nature of life without surrendering control. The longer you live, the more you realize control is often an illusion. What you can actually control is your response. Act with clarity, plan with awareness, but accept that some variables lie beyond logic. Don't assume your success is purely earned. Don't assume someone's failure is purely deserved. Treat both with balanced perspective. When you embrace luck and risk as permanent companions in life's journey, you become calmer, more grounded, and far more resilient than before. Enough, the hardest word to learn. The feeling of never enough is a silent disease of modern life. It creeps into our thoughts the moment we achieve something: a better job, a higher salary, a bigger house, and immediately we notice someone with more. And so we keep running. But this race has no finish line. If you don't define your own enough, exhaustion becomes your default. Enough is not a number, it's a mindset. It's the quiet recognition that what you have is sufficient for peace, security, and happiness, by your own standards, not someone else's. The problem is, society thrives on making you feel insufficient. Social media showcases highlight reels. Advertising sells insecurity disguised as aspiration. Comparison becomes reflex, and from there you fall into the upgrade trap. A new phone feels old within months. A new car becomes dull when your neighbor gets something flashier. A home that once felt spacious now seems small. Unless you draw your own boundaries, the world will keep shifting the goalposts. The answer isn't more, it's clarity. Writing down your personal definition of enough is a powerful act of rebellion and self-awareness. It can ground you. For example, enough might mean a modest home, quality time with your family, one meaningful vacation each year, and the freedom to retire without anxiety. When you reach that, stop chasing, celebrate, resist the pressure to constantly move the finish line. The ambitions of others aren't your blueprint. Your life isn't a competition. Enough is the starting point of serenity. People who know what enough looks like aren't lazy. They're liberated. They've realized that time, not stuff, is the most precious currency. Every extra hour spent working just to buy another non-essential thing is time stolen from your actual life. Knowing what's enough lets you say no with confidence. It lets you walk away from stress, from noise, from the toxic pursuit of approval. It brings you back to your values, your rhythm, your peace. In a world that constantly screams for more, the quiet whisper of enough is the loudest act of freedom. Fear paralyzes. It makes you sell your investments during a dip, delay your dreams because of bad headlines, or stay stagnant because now isn't the right time. But there is no perfect time. There's only the mindset you bring into uncertainty. Optimism is the quiet courage to take steps forward while others freeze. It's the discipline of preparation paired with the fuel of belief. If you want to grow in wealth, in life, you must stop worshiping pessimism. Caution is useful, but chronic doubt is a prison. History supports this. Financial markets, economies, and societies have all gone through cycles of crisis and recovery. Pessimists may be right in the short term, but optimists win in the long run. They keep investing, they keep building, they keep learning. Optimism doesn't mean ignoring risks. It means preparing for setbacks while believing in improvement. It's not blind faith. It's a strategic choice based on evidence and resilience. And in personal finance, this mindset can make the difference between wealth and regret. Pessimism, the logical sound that kills progress. Pessimism often sounds intelligent. It wears the mask of caution, experience, and insight. When someone predicts a market crash, a recession, or a dark future, people nod in agreement. That's because our brains are hardwired to respond more intensely to threats than to opportunities. But here's the paradox. While pessimism sounds smart, it rarely builds anything. Progress belongs to the optimists, the ones who believe in a better tomorrow and dare to act on that belief. They plant seeds while others panic. True wealth. What you can't see. True wealth doesn't shine. It doesn't make noise. It lives quietly beneath the surface, like the foundation of a solid home. It's not the luxury car, the designer watch, or the 5-star vacation. It's being able to sleep peacefully at night because you're not worried about bills. It's having the ability to take a break from work without panic. It's being able to make life decisions without begging for permission or borrowing to impress. Real wealth is freedom, built in silence, kept with intention. The flashy life often hides fragile foundations. Many spend to impress, not because they need, but because they want to be seen. They buy attention at the cost of financial peace. But the truly wealthy don't need to perform. They invest in assets, not appearances. They prioritize stability over status. They know that wealth is what's left when the spotlight fades. It's not about how expensive your lifestyle looks, it's about how sustainable your life is. Those who understand real wealth don't chase image. They don't measure success in possessions, but in peace of mind. Wealth isn't how much you earn. It's how long you could live well without needing to earn at all. It's the confidence that comes from being prepared. It's the calm that comes from not having to pretend. In a world obsessed with display, real wealth is invisible, but invaluable. You can't fake it. You can only build it, day by day, in quiet discipline. Status. The trap of the ego. Imagine seeing someone drive a luxury car down the street. Your first instinct isn't to admire the person. It's to picture yourself behind the wheel. You don't truly care who they are. You care about how it would feel to be them. This is the silent truth of status. People don't admire you for your possessions. They imagine how those things would serve their own identity. And if you're spending money to gain admiration, you're funding other people's daydreams, not your own fulfillment. Status is a game of perception. The ego craves validation, recognition, attention, so it pushes us toward financial decisions that don't make sense, buying things we don't need, to impress people we don't know, with money we don't really have. And the outcome? Pressure, anxiety, a life that feels performative instead of authentic. The truth is, most people are too caught up in their own insecurities to care deeply about your image. Freedom begins when you stop trying to prove something. Instead of spending to be noticed, live in a way that you feel proud of, even when no one's watching. Respect isn't earned through brands or appearances. It's earned through character, kindness, and consistency. The highest status is being secure enough to not seek status. When your self-worth isn't tied to what others see, you gain true control. Invest in substance, not spectacle. Because when the applause fades and trends change, what's left is who you are, not what you wore or drove. Let your life be rich in meaning, not just in impressions. Every time you decide not to buy something unnecessary, you're training yourself in financial discipline. You're reminding yourself that future freedom matters more than temporary pleasure. Automate your savings, treat it like a monthly bill. Pay yourself first. Don't wait until you have extra, because extra never comes unless you create it. A strong savings habit turns money into a tool, not a source of stress. You don't need a big income to save, you need a big reason. And that reason is this: peace of mind is priceless. Saving isn't about deprivation, it's about empowerment. When you have savings, you're not stuck in a job you hate. You're not panicking over car repairs or medical bills. You can walk away from toxic environments. You can support a loved one without hesitation. Savings give you leverage. They put you in a position of strength, not survival. It's not about how much you save, but about making saving a non-negotiable part of your lifestyle. It's an act of self-respect. Saving, the gateway to freedom. Saving is often underrated because it's quiet. It doesn't grab attention, it doesn't make headlines. But saving is power. Every dollar you set aside is a vote for your future. It says, I choose stability over impulse. I choose freedom over fear. Saving isn't just about building wealth, it's about building options. Whether it's a career change, a family emergency, or a dream you want to chase, savings are the foundation that makes choice possible. No savings, no choice. Freedom. The ultimate goal of money. In today's world, many define success by how much they earn or what they own. But the real purpose of money isn't to accumulate, it's to liberate. The greatest thing money can buy isn't a car or a mansion. It's the freedom to wake up each day and choose how to live. The freedom to walk away from toxic jobs, to spend time with your loved ones, to say no without fear. True wealth is not in what you show, but in how much control you have over your time and your choices. You don't need to be a millionaire to achieve freedom. You just need clarity and intention. The person who needs less often lives freer than the one who earns more. When your expenses are low and your lifestyle is intentional, you don't have to work to impress or survive. You work to create. You work because you choose to. That's the power of financial independence. It's not about retiring early. It's about living on your terms. That's the highest form of success. Freedom is not handed to you. It's built, decision by decision. Save deliberately. Avoid debt that owns your future. Spend with purpose, not pressure. Ask yourself constantly, will this decision bring me closer to freedom or farther from it? If it doesn't serve your highest values, it's not worth the cost. When your money aligns with your priorities, peace follows. You'll no longer live on someone else's schedule or dreams. You'll be living in alignment with your time, energy, and truth. That's what money was meant to serve. Financial stories, half the truth. People love stories of sudden success. Tales of overnight wealth, miracle investments, and one big win dominate headlines. But what these stories rarely reveal is the reality behind them. The years of quiet struggle, the setbacks, the sleepless nights, and the luck that no one mentions. The danger isn't that these stories are false. It's that they're incomplete. And when you base your decisions on half-truths, you risk building on unstable ground. The highlight reels don't show the hard parts, but those are where the real lessons live. Be skeptical of simplified success. Finance isn't a copy-paste game. No two journeys are the same. Timing, context, risk, and personality shape every result. When you get caught up in someone else's narrative, you can lose sight of your own path. Learn from others, but question what's missing. Look for the failure behind the fortune, the patience behind the payoff, the risks they didn't tell you about. Real wisdom lies in the untold backstory, and the most powerful story you'll ever write is your own. In conclusion, money isn't the destination, it's a tool. A tool that only becomes powerful when you understand yourself, know what's truly enough, and stay clear-headed amidst the noise of endless chasing. These principles weren't shared to be memorized. They're meant to be lived. Applied daily in how you spend, save, invest, and most importantly, how you pursue freedom. Let your mindset lead, not your emotions. Let clarity replace the compulsion to keep up. Because true wealth isn't measured by what's in your bank account. It's in your ability to live life on your terms every single day. 2025 is not the year to wait. It's the year to act decisively. In a world undergoing massive transformation, some stocks don't just offer returns. They give you the chance to be part of revolutions in technology, healthcare, and energy. This is the moment to look beyond charts, beyond headlines, and beyond the crowd. Not every stock deserves a place in your portfolio, but the 7 you're about to discover do, and they could be the turning point on your path to long-term wealth and significance. Now, let's dive into each of these stocks, where value isn't measured by share price, but by the future they're building. Biotechnology is no longer a risky playground for bold speculators. It's the infrastructure of tomorrow. As companies move from symptom treatment to gene-level intervention, investing isn't just about profits, it's about impact. This is where science meets finance, where capital flows to those brave enough to lead. Today's biotech disruptors are tomorrow's Apple and Tesla. Smart investors recognize this long before the masses do. Opportunities don't come from what's obvious. They emerge from what's forming. In biotech, companies with FDA-approved products, clear market potential, and robust pipelines stand at the edge of transformation. They're targeting rare and genetic diseases, markets with endless need and minimal competition. Every scientific breakthrough is a leap in revenue. And it's not just about sales, it's about setting new standards in global treatment. Investors don't chase after science, they invest in the future of humanity. The biggest differentiator in biotech is its non-financial leverage. A single clinical success can multiply market cap. But to win, you must look beyond balance sheets. You must see strategic alliances, regulatory trends, and unaddressed medical gaps. Imagine investing in a company that not only saves lives, but reshapes global healthcare protocols. That's not just buying a stock, that's buying into history. A leading biotech company is revolutionizing cystic fibrosis treatment. With a proven blockbuster product, it dominates its segment and generates billions annually. This cash flow funds R&D without dilution or debt, creating a rare financial foundation for sustainable growth. Their culture is relentless. Innovate, expand, repeat. It's not hype, it's DNA deep strategy. They're not stopping at treating symptoms. They're stepping into gene-level cures. Strategic alliances with CRISPR giants unlock a new frontier, correcting inherited diseases at the DNA source. What once seemed impossible is becoming a clinical reality. This isn't just better treatment, it's potential eradication. And investors who recognize that are not just betting on growth, they're owning a piece of medical evolution. Their pipeline expansion is aggressive and diversified. No reliance on a single product. Multiple treatments are in late-stage trials with commercial potential. The company is constructing a biotech empire, not just a business. Add in robust finances, visionary leadership, and industry tailwinds, and you have a rare compound of science, scale, and stability. This is not a choice, it's a defining opportunity for those who see what's next. Some stocks were once written off due to mounting losses in R&D. But when success hits, everything changes. This company emerged from near collapse through a multiple sclerosis breakthrough. MS is a $30+ billion global market, accelerating with an aging population. Few had the courage to burn capital for years. But when it works, returns can multiply tenfold. The competitive edge is not just clinical, it's patient-centered. Faster infusions, fewer side effects, stronger efficacy. Forecasts show a 64% revenue spike in a single year. This is no longer speculation. This is a true growth engine, and the best part, the company has reached profitability, real profits, real cash. That changes everything for cautious investors on the sidelines. This isn't a one-hit wonder. With renewed cash flow, the company is expanding research into new indications. A new wave is forming, and early investors stand at the front line. This is no longer a gamble, it's a strategic position in a company setting new neurological treatment standards. The market hasn't fully priced it in yet. But those who act now will be remembered as visionaries. In the turbulent world of biotech, a few companies choose a different path. Multiple revenue pillars, diversified products, and segmented markets. One standout player is tapping both blood cancer treatments and dermatology, two global markets worth hundreds of billions. What's remarkable is that both of their flagship products are already commercialized and generating stable revenue. While others chase trial results, they've already secured market share. For investors, this level of predictability is not just comforting. It's a financial bedrock for long-term capital appreciation, especially in a sector known for high risk. Their blood cancer drug, now considered a standard of care, pulls in billions annually and has strong support among physicians. Meanwhile, their topical vitiligo treatment is the first FDA-approved solution for a condition affecting millions worldwide. That means they aren't just another player. They're the pioneer. In dermatology alone, a $47 billion global market awaits. They opened the door first. And that wasn't luck. It was strategic foresight and clinical rigor. When a company defines a category, they don't chase market share. They own it. And investors who see this get rewarded with both margin and momentum. The true strength lies in their development pipeline. They're not relying on two products. They're already in advanced trials for multiple new indications. With stable revenue, controlled R&D costs, and a growing surplus, they're perfectly positioned for scalable, low-risk expansion. In a volatile industry, this company offers rare equilibrium. Strong legacy products, pipeline innovation, and defensive financials. For investors seeking a balanced approach, one that marries growth with consistency. This is not just a biotech pick. It's a portfolio cornerstone. One that doesn't just survive volatility, but thrives because of it. As the world accelerates toward net zero, aluminum has emerged as an unlikely star. Lightweight, durable, and infinitely recyclable, it's now essential to electric vehicles, solar energy, and sustainable architecture. One industrial giant, once challenged by commodity cycles, is staging a powerful comeback. Repositioned as a pillar of the green economy, it's poised to lead a global industrial transformation. With projected earnings growth of 314%, this isn't just a resurgence, it's a redefinition. For investors, it's a chance to invest in a legacy material that's found new life as an environmental and economic engine. Beyond demand tailwinds, this company has taken control of its future by acquiring a key supplier in its value chain. The acquisition of alumina secures upstream inputs, cuts costs, and boosts operational efficiency. In the world of materials, those who control inputs dominate pricing power. This company is doing just that, fast and decisively. Vertical integration isn't just a business move, it's a strategic moat, one that enhances profit margins, reduces volatility, and positions the company as a master of both production and pricing. That's how industrial players become investment legends. One more reason it stands out: it pays dividends. Unlike many high-growth peers, this company offers quarterly income while riding a long-term growth wave. Even in cyclical downturns, investors get paid. Combine that with ESG alignment, institutional interest, and strong fundamentals, and this becomes more than a stock. It's a high-conviction, income-generating, sustainability-aligned investment. In a world seeking clean energy, green construction, and resilient supply chains, aluminum isn't basic, it's strategic. And this company is writing its second act. For investors, the message is clear. It's time to take materials seriously. Again, in a field dominated by biotech giants, some smaller companies quietly lead in highly specialized, high-barrier niches. One standout is pioneering autologous cell therapies, where a patient's own cells are used to repair damaged tissue. They don't compete on scale, they compete on depth. And in medical segments where outcomes matter more than cost, that's a competitive edge that's nearly impossible to replicate. This is not about volume, it's about precision. And in markets like trauma, orthopedics, and critical care, precision doesn't just heal patients, it builds durable financial moats. Their flagship cartilage repair treatment is favored by athletes, patients who demand fast recovery, high performance, and proven results. Another product, designed for severe burn victims, addresses a medical category that few companies are capable of serving. In both cases, the company faces limited direct competition. That translates into premium pricing, customer loyalty, and sustained market share. They're not just participating in healthcare, they're shaping specialized markets from the inside out. For investors, this is a rare combination of scientific rigor, market exclusivity, and unmet clinical need. And that's a formula for exponential growth. Despite its smaller size, the company is scaling efficiently, posting 23% annual revenue growth and expanding its clinical partnerships. Strategic collaborations with hospitals and targeted marketing are driving adoption. Every new treatment center added is a new revenue engine. For investors with an appetite for asymmetric upside, this is a golden opportunity. Small-cap biotech isn't about hype, it's about timing and traction. When science meets execution, the result isn't just innovation, it's acceleration. And this company is built for both. Sometimes the most valuable gems aren't on the surface. They're waiting to be uncovered by those who look deeper. Healthcare is entering a new era, where artificial intelligence is not just an assistant, but a leader in diagnostics. A company in diagnostic imaging is leveraging AI to detect diseases faster and more accurately than ever before. From cancer to cardiovascular issues, their AI-driven systems are rewriting how we approach early detection. This isn't just about cutting-edge technology, it's about improving patient outcomes, reducing costs, and reshaping the healthcare landscape. AI is transforming healthcare, and those who invest in it today are positioning themselves in the forefront of a billion-dollar industry. The company's AI technology doesn't just enhance diagnostic speed, it improves accuracy, spotting abnormalities even experienced radiologists may miss. With a digital health revenue growth of 796%, their model is clearly working. AI enables the company to scale its operations quickly while improving healthcare outcomes across its 350-plus locations. The ability to integrate advanced tech into a traditional healthcare infrastructure gives this company a unique edge. It's not just a healthcare provider, it's a data-driven solution reshaping how the world thinks about diagnostics. For investors, this presents not just growth, but a paradigm shift. They're also expanding rapidly. With over 350 diagnostic centers, they have a strong physical presence that complements their technological innovations. The combination of widespread infrastructure and state-of-the-art AI gives them a distinct competitive advantage. As the demand for faster, more reliable diagnoses continues to rise, this company is perfectly positioned to become an integral part of the global healthcare system. Investing in this company means more than financial gain. It's about investing in the future of healthcare. This is not just about riding the wave. It's about creating the future of medicine. As the world shifts away from fossil fuels, renewable energy has become more than just a trend. It's a global imperative. One company, a recent spin-off from a major industrial conglomerate, is taking the lead in offshore wind energy and smart grid technologies. Their projects are not just innovative, they're transformative. With a projected earnings growth of 158%, they are at the forefront of an energy revolution. This is more than a business model, it's the future of the planet. For investors, it represents an opportunity to align financial success with a sustainable, green future. At the heart of their innovation is offshore wind energy. Their turbines are capable of generating power at an unprecedented scale, offering clean, efficient energy to thousands of homes with just one unit. The company is pioneering energy generation that is both powerful and sustainable. In addition to their wind projects, they're making strides in smart grids, ensuring that renewable energy can be distributed effectively across the globe. As governments around the world make serious commitments to reduce carbon emissions, this company is poised to be a critical partner in that transition. While there have been short-term setbacks, like delays in offshore wind turbine orders, their long-term strategy remains solid. With substantial government backing and a well-thought-out growth strategy, the company is strategically positioned to capture a significant portion of the renewable energy market. As global demand for clean energy continues to rise, this company is positioned for growth, making it an attractive investment. This isn't just about generating power, it's about powering a sustainable future. For investors looking to align their portfolio with global trends, this company is an essential piece of the puzzle. No single stock fits every investor. Success lies not just in picking winners, but in building a well-balanced strategy. For those seeking aggressive growth with higher risk tolerance, biotech disruptors are prime candidates. These companies can multiply wealth if clinical trials succeed, but they also carry volatility. Diversifying across multiple names and keeping position sizes appropriate is crucial. Don't go all in on a single breakthrough. Instead, create a layered approach that spreads risk while preserving the upside potential. In fast-evolving sectors, portfolio construction is as critical as stock selection. Risk can't be eliminated, but it can be engineered. For investors prioritizing stability, companies with commercialized products, cash flow visibility, and proven execution offer peace of mind. These firms may not double overnight, but they provide consistent returns with lower drawdowns. Think of them as portfolio anchors, reliable, adaptable, and quietly compounding. Their pipelines ensure continued growth, but their established products ensure resilience. In a market prone to overreaction, holding businesses that deliver predictable earnings is a form of protection. It's not about avoiding volatility, it's about neutralizing it with financial structure. In times of uncertainty, these stocks act as the calm in the chaos. But cash flow only works if paired with control. That's why elite investors obsess over risk management. They don't fear volatility, they prepare for it. Their portfolios are built like teams. Every asset has a job. Equities for growth, bonds for stability, real estate for yield, private equity for asymmetric upside, alternatives for hedging. This is asset allocation with intention. Nothing is random. Diversification isn't just a buzzword, it's protection. When one engine stalls, others keep the system moving. This is how the wealthy sleep at night. They don't eliminate risk, they neutralize it through structure and design. Opportunity doesn't reward hesitation. The 7 stocks we've explored aren't just potential profit drivers, they are gateways into industries reshaping the future. But execution matters. The first step is knowledge. Study earnings reports, examine product pipelines, listen to management strategy. Understand not just what the company sells, but where it's going and why it matters. The market rewards those who go beyond headlines. With clarity comes confidence, and with confidence comes decisive action. Strategy without action is just a dream. The edge belongs to those who prepare, position, and press forward when the signal is strong. Next, choose the right investment platform. If you're outside the US, use brokers that offer US equity access, transparent fees, multi-currency accounts, and clear tax reporting. Start small. Learn how each stock behaves. Don't bet everything on high-growth names. Blend aggressive picks with defensive plays and dividend payers. A strong portfolio isn't built on trends. It's shaped by principles. Know your risk tolerance. Adjust allocation as your goals evolve. Wealth isn't built in a single trade. It's crafted over hundreds of intentional decisions. Make every one count. Finally, maintain discipline and stay informed. Review earnings quarterly. Reassess your positions annually. Markets change. Your life changes. Your portfolio should evolve too. In investing, success isn't about being right once. It's about being resilient always. These 7 stocks are fast, bold, and future-facing. But you must be the captain. Choose when to board. Choose how long to ride. Choose when to shift course. The journey is yours. Profit isn't random. It's earned through consistency, clarity, and conviction. This isn't just about money. It's about building a future. One choice. One share. One step at a time. Investing isn't about guessing. It's about seeing. These 7 stocks aren't just tickers. They are invitations to join revolutions in science, energy, and technology. This is your moment to move beyond short-term noise and anchor yourself in long-term vision. The future belongs to those who study it, trust their process, and act with clarity. Wealth doesn't favor the passive, it favors the prepared. These companies are shaping the next decade. The question is, will you be a spectator or a stakeholder? The markets won't wait, and neither should you. The next move is yours. Make it count. Make it intentional. What if tomorrow you wake up and your job is gone? What if the industry you work in suddenly disappears? In a world where one line of code can replace an entire department and a single algorithm can erase a thriving profession, you simply cannot afford to rely on one income stream or one skill. This is not the era to wait or hope for luck. This is the time to take control. In this video, I'll give you the blueprint, tools, and strategies to diversify your income, expand your skill sets, and take full command of your financial journey. Because the world won't wait, but you can choose to lead. Now let's begin this journey, step by step, where you won't just learn how to earn more, but how to become an irreplaceable version of yourself, no matter what changes come your way. In a world full of disruption, where companies collapse overnight and entire industries get replaced by software, how will you stay grounded? If your income comes from a single source, you're walking a tightrope in a storm. One gust of change, a layoff, a shift in demand, a new technology can knock you down. Without diversification, your financial future hangs by a thread. Betting your entire life on one income stream or skill is no longer brave, it's reckless. Diversification is more than a financial strategy, it's a survival philosophy. It's your safety net, your shield, your immune system against chaos. Imagine having multiple income streams, a main job, a side business, investments, digital products. Alongside that, you've built a wide range of skills: communication, leadership, tech, creativity. That makes you unstoppable. No crisis can crush someone who has plan B, C, and D already in place. Diversification doesn't limit you. It liberates you. Studies have made it clear. By 2030, nearly 30% of current jobs could vanish due to automation. This is no longer a distant warning. It's a wake-up call. In a volatile world, success doesn't belong to the strongest, but to the most adaptable. So the question is not if, but when. Will you be caught off guard, or will you be prepared? Now is the moment to build your personal financial safety net and skill set buffer before the storm hits. The future rewards those who act before they're forced to. Before exploring side hustles or passive income, let's go back to the foundation, your active income. This is the money you earn through your core skill. Your job, service, or primary business. But the real question isn't, are you working hard enough? It's, are you being paid what you're worth? Many people work tirelessly but never stop to assess the true value they bring. Optimizing your primary income isn't about grinding more. It's about negotiating better, performing smarter, and knowing your value. Every extra dollar earned here becomes fuel for future income streams. The first step? Revalue yourself. Don't wait for an annual review to prove your worth. Initiate conversations about raises. Position yourself for promotions. And if your current environment stifles growth, dare to move on. Strategic career moves can increase your income faster than cutting expenses ever will. You don't need to work longer hours, you need to work with leverage. Remember, you are not stuck. Each move you make in your main career can unlock the capital you'll need to build long-term financial freedom. Active income, when maximized, gives you the power to multiply your options. If you want to become wealthy, start with your bookshelf. A good book could be worth more than a year of aimless work. An hour of reading could save you hundreds of hours of mistakes. In today's world, lack of knowledge is no longer a matter of conditions. It's a matter of choice. Choose to learn. Choose to rise. And remember, the successful are not the smartest. They're the ones who learn the fastest, act the earliest, and persist the longest with knowledge. We've been taught to work hard, but not necessarily to work wisely. It's time to shift that. You should become the master of your own skill set and income. Don't let your job define you. Instead, let it be a launch pad, a tool to fund your future. When you optimize your active income, you're no longer stuck working out of fear. You work with purpose. You take control of the game, instead of letting the game control you. This is how high performers think, and it's how you build toward true financial and personal freedom. A side hustle isn't just extra work, it's building an asset. It's how you create freedom by monetizing what you love and what you're good at. You don't need to quit your job or have a huge budget to start. You just need a skill, a passion, or a useful piece of knowledge, and the courage to package it into value for others. Whether it's tutoring online, writing content, selling digital art, consulting, or crafting, side hustles let you test, grow, and evolve without risking your main income. It's your financial sandbox and your future incubator. Start by observing yourself. What can you do better than 80% of people around you? That's your entry point. It could be designing presentations, editing photos, building websites, organizing events, or explaining complex topics simply. Platforms like Fiverr, Upwork, Etsy, Gumroad, and Teachable make it easier than ever to offer your talent to a global market. When you realize that your personal value can be repackaged into products and services and sold, you unlock a new level of self-worth. The market doesn't pay for perfection, it pays for usefulness. Be useful consistently, and the money will follow. Your side hustle is not just about money, it's about taking back creative control. It's where you get to test ideas without waiting for permission. It's where you gain confidence, independence, and skill evolution. Maybe your first ebook earns $10. Maybe your first design project is small. That's okay, consistency compounds. If you refine your offering, build trust, and scale gradually, your side hustle could one day outgrow your main job. But even if it doesn't, it still gives you leverage. It reminds you that your value is bigger than any title, job description, or monthly paycheck. The best part? You don't need to be perfect to start. You just need to start. You don't need a website, logo, or professional photos. Just one good idea, one clear offer, one step of courage. Write that first post, upload that first template, offer that first free consultation. Every step unlocks the next. And a year from now, you'll be grateful you didn't wait. Freedom begins when you decide to act on your potential. And a side hustle is how you practice becoming the kind of person who doesn't wait for opportunities, but builds them, one offer at a time. No one builds wealth by saving alone. Saving preserves money. Investing multiplies it. Investing is no longer a privilege for the rich. It's a tool for the ordinary person to become financially powerful, if started early and done consistently. When you invest, you separate time from income. Your money becomes your employee, working 24/7 even when you don't. That's why people who understand investing don't panic over job losses. They've built systems where cash flow doesn't stop when they do. Investing is the silent partner that works on your future while you sleep. Getting started with investing is much easier than most people think. You don't need millions, you just need momentum. You can begin with as little as $10 or $20 a month. Index funds, like ETFs, dividend-paying stocks, automated apps, real estate funds, all offer accessible entry points. The key is to be consistent, long-term focused, and intentional. Don't chase trends, follow timeless principles. Investing isn't about luck or risky bets. It's about building sustainable income streams over time. The earlier you start, the more powerful compounding becomes, and the less you'll have to work later. The magic of investing is in compound growth. When you reinvest your earnings, your wealth starts accelerating. That's why small, regular contributions matter more than big, rare ones. Even investing $50 a month in an index fund can become tens of thousands over 10 to 20 years. Not by chance, but by strategy. People often ask, is it too late to start? The best time was yesterday. The second best time is now. Each day you wait is a day you lose the exponential power of time. Investing isn't timing the market, it's time in the market that builds real wealth. Above all, investing is not a get-rich-quick scheme. It's a get-free-eventually strategy. You don't need to be a financial guru. You need discipline, vision, and patience. Start small. Learn a little more each month. Automate your contributions. Let your money grow while you focus on living, building, and learning. Investing is the ultimate habit of those who plan for their future, not react to it. Start today, not when it's convenient. The money you put to work now is what will buy you peace of mind, freedom of time, and options when you need them most. Active income keeps you alive. Passive income sets you free. It's money that flows whether you work or not. When you build systems that generate income without constant effort, you reclaim time, energy, and freedom. It's not a fantasy. It's a proven strategy used by entrepreneurs, investors, and creators around the world. Passive income allows you to step off the treadmill and start building a financial engine that works even when you rest. Every stream of passive income, no matter how small, adds resilience, reduces stress, and creates leverage. This is how wealth becomes inevitable. There are many ways to generate passive income. Selling digital products like ebooks or online courses, earning dividends from stocks, renting out property, licensing content, or building automated platforms like YouTube or podcasts. Yes, it takes work up front, but that effort compounds. You create once, earn forever. Imagine writing a simple guide or recording a helpful tutorial. Once published, it becomes a digital asset. You've now moved from trading time for money to owning a money-making system. This shift changes everything. Your time becomes more valuable because it's no longer the only way you earn. One golden rule: reinvest your passive income. Don't spend your first $50 from a product. Use it to build another one. Use your first dividends to buy more shares. Use YouTube revenue to market a new course. Every reinvested dollar is a seed that grows another tree. Compound returns aren't just for stocks, they work in every area of life. With consistency, you go from occasional wins to monthly revenue and eventually to full financial independence. The secret? Keep planting, keep optimizing, and above all, keep going even when results start small. That's how long-term momentum is built. Passive income doesn't come from wishing. It comes from building. Today, you might make only a few dollars from a small product, but if you keep creating, improving, and learning, that trickle can grow into a steady stream. Don't wait for the right time. The right time is now. Every passive system you build today will support the version of you 1 year, 5 years, or even a decade from now. It's not about replacing your job overnight. It's about building your freedom layer by layer, project by project. Start now, because the seeds you plant today change everything. No job is forever. No company is guaranteed. But the skills you carry, those are yours for life. In a world where industries are disrupted overnight, your best insurance policy is adaptability. And that comes from building transferable skills. These are the superpowers that travel with you, even when your role or field changes. They help you pivot fast, solve problems, lead, communicate, and think critically. If your industry collapsed tomorrow, would you still be valuable? Transferable skills are what make sure the answer is yes, always. They're your wings in a free fall. So what exactly are transferable skills? They're universal tools like leadership, communication, critical thinking, project management, time management, and digital literacy. These skills are in high demand across every industry, and they never go out of style. They allow you to move between roles, departments, or even careers. A customer service rep who learns data analysis can move into operations. A teacher who learns video editing can create online courses. When you combine hard skills with versatile soft skills, you become the kind of person who doesn't fear change. You use it as fuel for reinvention. To develop your transferable skills, use the T-shaped model. Go deep in one expertise and go broad across related areas. If you're a designer, learn UX principles or motion graphics. If you're in sales, study copywriting or marketing psychology. These expansions multiply your opportunities. Each new skill you learn increases the number of ways you can create value for employers, clients, or yourself. More value means more income. More versatility means more resilience. In a fast-changing world, specialists thrive. But hybrid professionals thrive longer and go further. Be someone who grows roots and branches. Most importantly, transferable skills protect your long-term relevance. You can't predict the future, but you can prepare for it. Every skill you build today becomes a buffer against uncertainty tomorrow. People who invest in their abilities never run out of options. They don't panic when the rules change. They adapt. If you want to become recession-proof, disruption-proof, and irreplaceable, focus on becoming skill-rich. Don't wait until you're forced to learn something. Start now with what you already enjoy. One new skill per month can change your entire trajectory in a year. Learn relentlessly. Apply often. Evolve constantly. In today's world, success doesn't only come from what you know, it often comes from who you know. Not every opportunity is posted on a job board. In fact, 85% of the best jobs and collaborations happen through personal networks, referrals, and direct introductions. That's not luck or favoritism. That's the power of connection. Building relationships is a high-leverage habit that fuels income growth, career shifts, new partnerships, and fresh ideas. Your network is your bridge to new income streams and untapped knowledge. The question is, are you investing in that bridge or ignoring it altogether? Networking isn't begging, it's giving before asking. It's about leading with value. Ask yourself, how can I help others grow? Maybe you can share knowledge, introduce someone to a contact, offer feedback, or show support. These small gestures build trust. When you consistently contribute to others, opportunities start gravitating towards you. Being helpful makes you memorable, and being memorable makes you magnetic. In a noisy world, generosity is your advantage. Never underestimate the power of a thank you note, a thoughtful comment, or a sincere offer to collaborate. Relationships grow not from tactics, but from authenticity. Each person you connect with is a potential multiplier for your growth. Join communities, attend industry events, reach out to mentors, work with people smarter than you. Collaborate across skill sets. People help you learn faster, adapt smarter, and reach further. Alone, you can go fast. Together, you can go far. When you surround yourself with the right people, you don't just accelerate your income, you elevate your standards. In the end, success is not a solo journey, it's a team sport. Build your ecosystem one conversation at a time, and it will pay you back for life. Reading this far means you're serious about taking control of your life. You now understand the principles: diversification, skill building, income layering, and strategic investing. But knowledge without action is potential left unrealized. So let's turn ideas into impact. You don't need a perfect plan, you need movement. Here's a 7-day roadmap to kickstart your transformation. No fluff, no overwhelm, just one intentional step per day. After 1 week, you'll go from stuck to in motion, and motion creates clarity, confidence, and consistency. This isn't theory anymore. It's your invitation to rise above limits and start building your new reality. Day 1-2. Write down 3 skills you're great at and 3 topics you're deeply passionate about. Now find the intersection where you can add value to others. That sweet spot is your side hustle seed. Unsure where to start? Ask friends, what do you always come to me for? Their answers will reveal what you're already known for. This isn't just self-reflection, it's self-positioning. What you're good at and what people need overlap more than you think. When you identify this zone of opportunity, you're no longer guessing. You're choosing where to plant your first income stream. Day 3-5. Choose one platform: Fiverr, Gumroad, Substack, Etsy, Upwork, and publish something. Offer a service, launch a product, or share knowledge. Done is better than perfect. Meanwhile, open an investment account and contribute a small amount, even $10. Starting small is the secret to starting. Don't wait for when I have more time or after I learn more. Clarity comes from action, not more thinking. You're not building for overnight results. You're building a long-term system. These 72 hours are about becoming someone who takes initiative, not just consumes information. This is where identity shifts. Day 6-7. Connect with 3 people who inspire you in your field of interest. Comment on their posts, message them with thoughtful questions, or share something valuable. Relationships open doors that strategies alone can't. At the same time, outline your next week. What's the next skill you'll learn? What can you refine in your offer? Action brings feedback, and feedback builds progress. Momentum is a choice. 1 week from now, you'll look back and realize you didn't need more resources, just resourcefulness. The next level of your life is already waiting. Now it's your move. Let the building begin. True financial freedom doesn't come from working harder. It comes from working smarter and diversifying. It comes from taking control of your skills, your income, and your future. Every step you take today is an investment in your tomorrow. It's time to stop waiting for the right moment, because that moment is now. The habits you build, the skills you acquire, and the income streams you create today will lay the foundation for a life of freedom and choice. It's not about perfection, it's about progress. So start now, take action, build momentum, and trust the process. The future you want begins with the choices you make today. Your time is now. Let's make it count. Have you ever wondered, why do the rich keep getting richer despite crises, volatility, or recessions? It's not because they know a secret that ordinary people don't. It's because they possess a completely different investment mindset: sharp, long-term, and action-oriented. In this video, we will break down 5 types of assets that billionaires are investing in right now, from stocks, real estate, private equity, alternative assets to bonds. But we won't stop at the what. We will dive into the why and how, so you can start building wealth like the rich. Get ready, because the journey into the financial mindset of the ultra-wealthy begins right now. Stocks, the art of ownership, not gambling. Stocks are not codes you flip for quick profits. They are fractional ownership in real businesses. When you invest in stocks with the right mindset, you're no longer an outsider. You become a shareholder, a strategic participant in that company's long-term vision. The wealthy don't chase market noise. They buy into operations, cash flow, and growth. They don't look for what's cheap. They look for what's valuable over time. That's why equities are the foundation of long-term wealth. The key is ownership, not speculation. Wealth is created through participation in solid enterprises, not by reacting to daily fluctuations. Success in the stock market isn't about luck. It's about selecting companies with strong fundamentals, consistent revenue, scalable business models, healthy balance sheets, competitive advantage, and transparent leadership. Investors don't randomly pick stocks. They own businesses they believe in. Cash-flowing companies that pay regular dividends become passive income machines. The smart strategy is not timing the market, but time in the market. And when you reinvest dividends, you unlock compounding, the most powerful force in wealth creation. The wealthy use this tactic relentlessly, allowing their capital to multiply without needing to trade or time exits. Smart investors detach from short-term emotions. They apply dollar-cost averaging, investing a fixed amount regularly, regardless of market swings. This flattens volatility and builds consistency. When markets fall, they buy more shares. When markets rise, their positions grow. This method eliminates paralysis from overanalyzing when to buy. You don't need to be perfect, you need to be disciplined. The wealthy don't guess market bottoms. They deploy capital consistently and stay invested. Your advantage isn't prediction, it's participation. Build wealth like a system, not a gamble. Long-term investing wins not by being right often, but by being steady always. Another approach is investing in index funds. Rather than hand-picking stocks, you gain exposure to hundreds of the best companies through a single investment. Funds like the S&P 500 reflect the overall economy, and are used even by the ultra-wealthy to preserve and grow capital without micromanaging. You minimize risk through diversification and maximize time efficiency. This method is ideal for beginners and veterans alike. You don't need complex strategies. You need consistency and focus. Wealth is not about being clever. It's about having a process. Index investing offers just that: low cost, high performance, and reliable growth. In summary, stock investing isn't gambling with prices. It's building wealth through ownership. Choose companies with a long-term edge. Focus on businesses that pay you while you sleep. Reinvest that cash flow. Be consistent with your contribution. Ignore market drama. And never invest with hope. Invest with a plan. This is the true difference between someone who trades and someone who builds. The rich don't gamble their future, they engineer it. And you can do the same. It starts with a shift in perspective. From trader to owner, from noise to fundamentals, from emotion to execution. Real estate. Cash flow over luxury. Real estate isn't about flashy homes or impressive views. It's a tool, a high-leverage income-generating machine that produces two things every investor needs: cash flow and appreciation. The wealthy don't just buy property for status, they buy for performance. When done right, real estate becomes a double engine. Rental income feeds your cash flow, and the property itself gains value over time. That's why real estate remains a cornerstone in nearly every serious portfolio. It's not just a place to live, it's a financial asset that pays you. Smart investors buy income streams, not wallpaper. Strategic real estate investing begins with numbers, not emotions. Savvy investors analyze location, infrastructure, occupancy rates, tax impact, and the potential for long-term value growth. They calculate expected cash flow and use data to decide, not personal taste. Every property is evaluated as a business unit. Is it producing a positive return after costs? What's the ROI over 10 years? What is the exit potential? This is how high-level investors think. Real estate isn't emotional, it's mathematical. And those who master the numbers unlock a source of stable, inflation-resistant income that compounds silently, month after month. One of the most powerful tools in real estate is leverage. The wealthy rarely buy properties with 100% cash. They use other people's money, banks or private lenders, and let rental income pay off that debt over time. This amplifies returns and preserves capital. The equity grows, and your cash investment remains minimal. You control a large asset with a smaller outlay. The appreciation builds in your favor while someone else pays your loan. That's not risk. That's precision. Smart leverage lets you scale faster and gain exposure to multiple assets without tying up all your liquidity. You don't need millions to start. Platforms like REITs, real estate investment trusts, let you invest fractionally in income-producing properties and collect dividends without owning or managing a building. You can also use the house hacking model. Buy a multi-unit property, live in one unit, and rent out the others. This offsets your mortgage and builds equity fast. The key is thinking like an investor, not a tenant. Real estate isn't just a place to stay, it's a long-term money machine. You just need to approach it with data, discipline, and a clear exit or growth strategy. Real estate won't make you rich overnight, but it will make you wealthy over time if you treat it like a business. Focus on deals that produce monthly cash flow and long-term value. Don't chase trendy neighborhoods. Chase fundamentals. Know your numbers. Use leverage smartly. Maximize tax benefits, and always protect your downside. Real estate is not a trophy, it's a system. Once it's in motion, it works for you 24/7. That's how true wealth compounds, through assets that generate income while you focus on the next opportunity. Own properties, or better yet, own cash-flowing systems. Private equity, investing before the world notices. Private equity is where wealth is made quietly and exponentially. It's the arena where investors fund private businesses before they go public, before the market even knows they exist. These companies are in early or growth stages, with huge upside potential and limited public attention. This is not gambling. It's asymmetric investing. Small capital, massive upside, longer horizon. When chosen wisely, a single private equity deal can yield returns that dwarf public stock investments. The catch? It requires vision, patience, and high conviction. The rich don't wait for IPOs, they're already in long before the headlines break. Private equity is not just about capital, It's about value creation. Investors don't just inject money. They provide connections, strategic input, advisory power, and board-level influence. This active involvement turns capital into acceleration. Private equity participants become part of the business growth story. They co-engineer outcomes. It's a model of engaged ownership where value is multiplied through insight, execution, and network effects. This is how insiders turn 100K into millions. Not because of luck, but because of leverage and access. The wealthy don't just fund ideas, they shape them. And in doing so, they unlock transformational results. You no longer need to be ultra-wealthy to enter this space. Crowdfunding platforms like Republic, Seed Invest, and AngelList have opened doors to retail investors. With as little as a few $1,000s, you can back startups with scalable potential. But access alone is not enough. You must vet the team, study the business model, assess market demand, and analyze growth paths. In private equity, due diligence is the armor. Success requires you to think like a venture capitalist, not a dreamer. Every investment is a bet on the future, and only well-informed bets deserve your capital. One truth about private equity: liquidity is limited. You may need to hold for 3 to 7 years before seeing a return. This isn't for people chasing quick exits, but that illiquidity is what allows patient capital to grow undisturbed. The richest investors aren't flipping stocks, they're planting trees. While others check prices daily, they quietly nurture assets with 10x potential. And when the exit arrives, whether through acquisition or IPO, the reward is often game-changing. If you can afford the wait and do the research, private equity is one of the sharpest tools in your wealth arsenal. Private equity isn't just an investment. It's a mindset. It's the discipline to act early, before validation, and the clarity to know what's worth backing. It's the courage to tie up capital today for exponential gain tomorrow. The wealthiest don't play in obvious spaces. They find value where others hesitate. If you adopt the same mentality, filtering hard, diversifying wisely, and holding firm, you can access opportunities the public won't see until they're priced out. Private equity is for the bold, the strategic, and the patient. That's how fortunes are made, before the market wakes up. Alternative assets, diversifying beyond the obvious. Alternative assets are the unsung heroes of real wealth. These are investments outside the typical triad of stocks, bonds, and real estate. Think fine art, vintage wine, farmland, cryptocurrency, rare collectibles, and precious metals. Why do the wealthy love them? Because these assets behave differently. They're often uncorrelated with traditional markets, which makes them ideal for buffering volatility. When stocks crash, rare assets often hold or even increase in value. In other words, they're not just different, they're defensive and opportunistic. For the elite, these are tools of preservation, protection, and unorthodox profit. What makes alternative assets special isn't just performance, it's access and scarcity. There's only one original of a painting, only so much fine wine, only so much arable farmland. These limitations create inherent value, but beyond supply and demand, they carry emotional and cultural weight, making them attractive to affluent buyers. And as demand grows globally, so does value. The wealthy don't think in quarters, they think in generations. That's why they buy assets that transcend markets and outlast cycles. In their playbook, preservation is just as important as multiplication. Alternatives provide both, when used wisely. Today, technology makes it easier than ever to get started. Platforms like Masterworks let you buy fractional shares of fine art. Vinavest lets you invest in high-end wine without owning a cellar. Real estate-backed agricultural REITs let you hold farmland without farming. Cryptocurrency opens doors to digital scarcity. These options offer real exposure, without traditional barriers. You no longer need millions to play this game. What you do need is research, a risk-adjusted mindset, and intentional portfolio design. Alternatives aren't toys, they're tactical assets, and they become powerful when they're part of a bigger strategy, not isolated bets. Of course, alternative assets are not for the uninformed. Each category has its own rules, risks, and metrics. Art needs authentication. Wine needs climate control. Crypto requires cybersecurity. Farmland depends on yield and location. These aren't set-it-and-forget-it investments. You must understand your entry, your exit, and how value is created. This is the part where most fail. They jump into trends without understanding fundamentals. Don't be that investor. Study. Start small. Learn the nuances. The wealthy succeed here not because they know everything, but because they know enough to control risk and compound gains. Ideal allocation for alternatives? Typically 5 to 15% of your portfolio, just enough to add a new growth vector and a layer of resilience. Spread risk across categories, 1 part digital, 1 part tangible, 1 part yield producing. Always connect each asset to a purpose. Hedge inflation, store value, preserve wealth, or diversify risk. And never confuse novelty with quality. Wealth isn't built on what's new, it's built on what works. When alternatives are used strategically, not emotionally, they become force multipliers. Because sometimes the best opportunities lie just outside the spotlight, waiting for someone bold enough to act. Bonds, the silent anchor of every strong portfolio. Bonds are not flashy, but they're foundational. In times of market chaos, bonds provide a safety net of predictable income and capital preservation. They are the quiet workhorses in a diversified portfolio. Bonds generate fixed interest payments and maintain value even when equities tumble. For wealthy investors, bonds are not about chasing returns, but about securing resilience. They allow portfolios to weather volatility while still generating steady cash flow. Think of them as the ballast in a ship, invisible when seas are calm, but critical when storms hit. True wealth management always includes a strong defensive line. The beauty of bonds lies in their consistency. Treasury bonds offer virtually risk-free returns backed by government security. Municipal bonds come with tax advantages, especially valuable for high-net-worth investors. Corporate bonds pay more, but require credit analysis. Bond ETFs allow instant diversification across maturities and sectors with low cost and high liquidity. No matter the type, bonds pay you to wait. They don't require market timing. They simply deliver steady income on schedule. That predictability is why sophisticated investors use them to stabilize portfolios and fund other strategies. In a world of uncertainty, consistency is an asset class on its own. Bonds aren't about excitement, they're about control. When stocks are soaring, bonds look boring. But when stocks collapse, bonds offer peace of mind. They act as shock absorbers during downturns. That's why smart investors never go all in on risk. They hedge with stability. Bonds smooth out returns and reduce the overall drawdown of your portfolio. This isn't speculation, this is structure. The goal of wealth building isn't to impress, it's to endure. A well-balanced portfolio isn't just about growing fast, but about never going backward too far. Bonds keep you in the game when others get wiped out. Bonds also serve a key function in cash flow planning. If you're nearing retirement or building passive income systems, bond ladders can offer regular payouts. These structured portfolios hold bonds that mature in sequence, releasing capital and income at predictable intervals. That kind of visibility matters. It helps fund living expenses, reinvest opportunities, or cover downturns elsewhere. Bonds aren't just safe, they're strategic. They give you time, options, and breathing room. The wealthy don't use bonds for thrills, they use them to maintain control. Because losing money is more costly than missing out. Stability isn't a luxury, it's leverage. If you're new to bonds, start simple. Government treasuries or bond ETFs are great entry points. As your capital grows, explore more advanced instruments like municipal bonds for tax efficiency or high-grade corporates for yield. But never underestimate their value just because they're boring. In a portfolio built for long-term wealth, boring is beautiful. Bonds let you play offense more aggressively with other assets, knowing you've protected your downside. That balance, growth plus defense, is what keeps the wealthy wealthy. In a world that celebrates speed, bonds are proof that endurance still wins. Silence doesn't mean weakness, it means strength. Cash flow and risk management, the billionaire mindset in action. Wealth isn't measured by assets, it's measured by cash flow. The truly wealthy don't just accumulate things, they acquire systems that generate income, month after month, whether they work or not. Rental properties, dividend stocks, interest-bearing bonds, and business equity all produce predictable, recurring income. That's the real goal. Not just to grow your net worth, but to fund your lifestyle without touching principal. When your assets pay for your life, you're financially free. The rich don't focus on ownership alone, they focus on income generation. Cash flow is the fuel that turns financial plans into real freedom. But cash flow only works if paired with control. That's why elite investors obsess over risk management. They don't fear volatility, they prepare for it. Their portfolios are built like teams. Every asset has a job. Equities for growth, bonds for stability, real estate for yield, private equity for asymmetric upside, alternatives for hedging. This is asset allocation with intention. Nothing is random. Diversification isn't just a buzzword, it's protection. When one engine stalls, others keep the system moving. This is how the wealthy sleep at night. They don't eliminate risk, they neutralize it through structure and design. Leverage is another secret, and it cuts both ways. Used poorly, it destroys portfolios. Used wisely, it multiplies results. The wealthy borrow not to consume, but to expand. They use leverage to control larger assets that produce higher income than the cost of debt. That gap, the spread, is profit. But it only works when managed tightly. Every leverage position must be cash flow positive. If it isn't, it's a liability, not an asset. Leverage is a tool, not a crutch. Used with discipline, it's a weapon. Used carelessly, it's a bomb. The difference is education and restraint. Hedging is another powerful defense mechanism. Wealthy investors always have a plan B: cash reserves, precious metals, inflation-protected securities, and uncorrelated assets that act as shock absorbers. They assume chaos will come and position accordingly. They don't overexpose themselves, they build redundancy into their systems. This mindset is what separates amateurs from professionals. In financial storms, the unprepared drown. The prepared pivot. Risk is inevitable. Ruin is not. When you hedge, you buy time. And time is the most powerful financial asset of all. The rich use it to reassess, reposition, and relaunch, while others are still reacting. Ultimately, wealth isn't about luck, timing, or secret hacks. It's about systems. Systems that generate cash flow, absorb risk, and grow intelligently. Systems you build once and refine forever. Systems that turn income into assets and assets into freedom. The rich don't rely on emotion, they rely on frameworks. And so can you. Build your financial engine one piece at a time. Stay consistent, learn relentlessly, act deliberately. The journey to wealth is not explosive, it's exponential. Not overnight, but over time. Start now, not someday. Because wealth isn't just built by those who know, it's built by those who move. In conclusion, owning assets is not the destination, but the means to lead you to true freedom. Through the 5 types of assets that the ultra-wealthy are investing in, from stocks, real estate, private equity, alternative assets to bonds, you can see clearly. Wealth does not come from lucky opportunities, but from strategy, cash flow, and intelligent risk management. Now is the time to start applying. Small, consistent steps with a long-term mindset. Don't wait for everything to be perfect before acting, because the only difference between those who build wealth and those who stand still is the action taken today. Your financial future begins with the decision you make right now. Have you ever thought that to become wealthy, you need luck, powerful relationships, or a billion-dollar invention? The truth is completely the opposite. Wealth is not a privilege. It is the result of a mindset, habits, and consistent actions. In this video, you will discover the 7 habits that have changed the lives of millions, from simple books, detailed budgets, to high-level investment strategies and connections. This is not just advice. This is the blueprint to building a life of financial freedom, sustainability, and completeness. Ready to turn the page for your financial journey? The journey to becoming a millionaire doesn't start with numbers in your bank account. It begins with how you think, choose, and live each day with clear goals, sharp knowledge, and uncompromising discipline. Wealth doesn't start with a bank account. It starts with the brain. Reading every day is a revolutionary act in transforming your perception of money. It's a declaration of refusing to stay financially ignorant. Books, articles, financial research, whether simple or advanced, are pieces that form the map to freedom. Not everyone is born understanding investment, compound interest, or income optimization. But anyone can learn. Anyone can start from zero. The issue isn't that you know little. The issue is that you don't want to know more. When you begin dedicating 30 minutes a day to reading financial books, you're not just learning about money. You're training your mind to think like the wealthy. You don't need to understand all investment tools in one day. but you must have the courage to step into a world you once thought wasn't meant for you. Knowledge is power, but it only becomes yours when you use it. Finance is not a game of chance. It's a game of information. The winner is the one with sharp thinking, continuous updates, and action based on understanding. You can spend your time watching movies, scrolling the web, or entertaining yourself. But if you dedicate just 10% of that time to learning about asset management, your financial future will change forever. It all begins from one page, one blog post, or one investment newsletter. When you read, you activate your own potential for wealth. The reading habit doesn't have to start with classic books or jargon-heavy terms. Start with what's close to you: how to spend effectively, how to save smartly, cash flow principles. When you're interested, you'll naturally expand into bigger topics like the stock market, real estate, or entrepreneurship. Reading isn't a one-time action, it's a living habit. It's a manifestation of a growth mindset. And most importantly, it is the first step to breaking free from the financial trap. No one is born understanding compound interest, ETFs, or risk management strategies, but you can absolutely learn. When you read daily, you begin to connect scattered knowledge into a system. You understand why investing early matters, why avoiding bad debt is crucial, why smart saving differs from tightening your belt. And once you understand, you're no longer a victim of the financial system. You become the controller, the creator, the leader of your own financial game. If you want to become wealthy, start with your bookshelf. A good book could be worth more than a year of aimless work. An hour of reading could save you hundreds of hours of mistakes. In today's world, lack of knowledge is no longer a matter of conditions. It's a matter of choice. Choose to learn. Choose to rise. And remember, the successful are not the smartest. They're the ones who learn the fastest, act the earliest, and persist the longest with knowledge. A budget is not a limitation. A budget is a declaration of freedom. When you control every penny that comes in and goes out, you are no longer a slave to impulse spending, to advertisements, or the fear of running out of money at the end of the month. Budgeting is not about punishing yourself. It's how you tell yourself, I know what I'm doing with my financial life. Poor people see budgeting as restrictive. Wealthy people see budgeting as a weapon. Budgeting is a management mindset. It transforms you from a consumer into an operator. When you create a clear spending plan, you create structure in your life. You define what's fixed, what's flexible, what's for future investment, and what's for current consumption. Every penny has a mission. No penny is wasted. This isn't just a financial equation, it's a lesson in awareness. Budgeting creates proactivity. When you know how much you need for living expenses this month and how much for savings, you no longer live by emotion. You live by design. You have a risk management plan. You have an emergency fund. You have vision. And most importantly, you have peace of mind. No one can control the market entirely, but you can control your reactions, and budgeting is the tool that helps you do that. Many people think budgeting is only for those with a lot of money. In reality, the opposite is true. Budgeting is the prerequisite for creating money. The wealthy don't wait until they have a lot to manage. They manage every penny from the start. If you have a low income, budgeting is even more essential, because you don't have room for mistakes. Every wrong spending decision is a step back from financial freedom. Budgeting not only saves you today, it builds the foundation for tomorrow. In today's technological era, budgeting has never been easier. Financial management apps help you track your spending in real time. You can categorize transactions, set spending limits, and receive alerts if you exceed them. But no matter how advanced the tools are, the root still lies in your willpower. The willpower to track, to adjust, and to maintain discipline when temptations surround you. Budgeting is the tool, but you are the controller. Use it like a sword to lead you to wealth. Investing is not a game for the rich. Investing is the game for those who understand the value of time. When you invest early, you don't just create wealth, you create freedom. Freedom to choose, freedom to rest, freedom to live life as you wish. Compound interest doesn't favor anyone. It only rewards those who start early and persist. $1 invested today could turn into 10 tomorrow, but only if you start. And you must start now. Compound interest is the miracle of the financial world. It's like a snowball rolling down a hill. The longer it rolls, the bigger it gets. A small investment, but maintained consistently, will far surpass a large investment made sporadically. The difference isn't in the capital, it's in the time. Time is the investor's greatest asset. That's why the younger you are, the greater the advantage. Early investing doesn't require you to be an expert. It only requires belief and action. Belief is the key factor, not in the market, but in yourself, in your long-term vision, in your personal discipline. The market will go up and down, news will change, others will panic, but you will continue to invest steadily despite emotions. That's resilience. Investing is not for those seeking absolute certainty. It's for those who understand that risk is part of growth, and the reward only comes to those who are patient. Forget the misconception that investing is only for the rich. The reality is, the rich are wealthy because they invest. They don't keep money in a savings account waiting to lose value. They use money to create more money. You don't need much to start. It could be a few hundred each month into index funds, reputable stocks, or other income-generating assets. What matters most is not how much you start with. What matters is whether you start, because not investing means losing money every day. Investing is also an expression of long-term thinking. It requires you to look beyond tomorrow, to overcome procrastination, and to conquer the fear of making mistakes. Anyone can invest, but not everyone has the commitment to maintain it. When you see investing as part of life, you redefine your relationship with money. It's no longer earn, spend, end. It's earn, keep, multiply. That's the foundation of true financial freedom, a sustainable foundation that grows stronger over time. The most important asset you can build is not in the bank, but in your contact list. Your network is the invisible leverage that creates breakthroughs in both finance and career. No one succeeds alone. Every big step forward carries the mark of a timely conversation, the right advice, or a handshake at the right place. This isn't luck, it's strategy. And you need to actively create that strategy. Building a network doesn't mean handing out business cards or making random friends. It's the process of creating deep, valuable relationships. Every person you meet is a different world. Learn how to listen, empathize, and contribute. When you connect from a place of true value, you create lasting relationships. These relationships will open doors, provide support when needed, and create long-term positive momentum. This is investing in people, and this is an investment that never loses. Be present in places where value converges. Industry events, learning communities, advisory groups, entrepreneur forums. Actively ask questions, share knowledge, and open yourself to new perspectives. Sometimes a small story can lead to a big idea. A random connection can turn into a future partner. But no one will find you if you always hide in your comfort zone. Let others know who you are, what you do, and what you're looking for. Your network is not something to use only when needed. It's an ecosystem you build every day. Nurture it as you would a garden. Send thank yous, share resources, and remember others' milestones. When you become someone who always brings value, others will want to stand by you. And when the wind of opportunity blows, you'll have the sails of relationships wide enough to sail toward the future. This is how successful people replicate their speed to success. If you want to become wealthy, you must break through your old self. The greatest asset is not money or real estate, it's mindset. Successful people never stop learning. They don't allow themselves to be confined by old knowledge. They believe that each day is an opportunity to update, expand, and refresh. In a rapidly changing world, those who stop learning will be left behind. Those who keep learning will lead, and you have full control over the path you choose. Continuous learning doesn't mean going back to school or getting another degree. It's the process of activating curiosity, proactively expanding your horizons. You can learn through books, podcasts, online courses, seminars, or even through a conversation with someone smarter. The important thing is to never stop asking, can I do better? What do I need to know to level up? Growth is never random. It always starts with purposeful learning. The issue isn't that you know little, it's that you think you know enough. The biggest trap in the financial journey is the mindset of, I already know. When you think you don't need to learn anymore, you close the door to change. Always remind yourself, Markets change, technology changes, customer behavior changes, and you must change too. The smart person is the one who always maintains a learner's mindset. A humble, forward-thinking mindset that never stops exploring. Make learning a lifestyle. One book a week. One podcast a day. One new skill a month. The magic doesn't lie in the information. It lies in the process of reshaping yourself. When you continuously update yourself, you become more flexible, more confident, and wiser in all financial decisions. The person who knows how to learn is the one who controls their destiny, and they will be the ones to open paths that no one else ever expected. Learning is power, and you hold the key to it. Without goals, every effort is easily scattered. Goals are the compass that guides actions, the light that directs you through the chaotic sea of financial information. When you know what you want, you no longer waste money on fleeting things. You begin to spend strategically, no longer living by emotions. A clear financial goal activates planning thinking, helping you step back to see the big picture. And from there, you know how to proceed. Good goals can't be vague. I want to be rich is a dream. Create 1 billion VND in 5 years through investment is a goal. It has figures, a time frame, and specific actions. When you write down your goal, you turn an idea into a commitment. When you break the goal into steps, you make the journey achievable. Every small step achieved is a huge source of motivation. You don't need to rush, you just need to keep moving. Each day you stick to your goal, you get closer to success. Successful people don't set goals to feel pressure. They set goals to have reasons to overcome procrastination. When you know why you need to save, you'll overcome the temptations to spend. When you know you want financial freedom by the age of 40, you'll start investing instead of postponing. Goals are not just destinations. Goals are the driving force of life. And if you don't set them for yourself, society will set them for you. With bills, debt, and a life of no autonomy, you can have the perfect plan. You can have clear goals, but without discipline, everything remains on paper. Discipline is the bridge from ideas to results. It's the ability to take action even when you're not inspired. It's the strength to say no to instant gratification and say yes to long-term freedom. Successful people don't rely on inspiration to act. They rely on systems and personal discipline. Discipline is not restriction. It's the tool that frees potential. Discipline doesn't appear overnight. It's built day by day, starting with the smallest things. Don't shop impulsively, stick to your budget, invest on schedule, read financial books on time. Each time you maintain discipline, you strengthen your trust in yourself, and that trust will be the fuel for your long-term journey. Remember, no one will see you reject that discount shirt today, but that very action helps you accumulate enough to invest tomorrow. Temptation is always present. It could be the new phone, a luxury trip, or a super high-return investment offer. But if you have discipline, you won't be swayed. You know that real value isn't in flashy displays, but in stability. Discipline helps you stay on course, even when everything around you wavers. It helps you continue when others quit. And ultimately, it's discipline, not luck, that will take you to the finish line. Wealth doesn't come from a single action. It comes from a sustainable system of habits practiced every day. Read to enlighten, budget to control, invest to accumulate, connect to expand, learn to adapt, set goals to guide, and discipline to maintain it all. This is not a secret. This is a strategy. You don't need the perfect starting point. You just need to commit to begin. And then, step by step, habit by habit, decision by decision, you will reach where many only dare to dream. What if I told you that just $20 per week, the cost of a cup of coffee, could create a passive income stream of over $6,000 every month? Would you believe it? This is not a get-rich-quick scheme. It's a financial strategy built on the power of dividends, smart reinvestment, and most importantly, time. No need for luck, just discipline. No need for large capital, just the willingness to start early. In this world, those who know how to plant seeds consistently are the ones who reap financial freedom the soonest. So, how can $20 a week turn into a wealth machine worth hundreds of thousands? Let's start with what seems small. The psychological power of $20. Small but life-changing. A $20 bill can easily pass through your hands every week without leaving any impression. A Starbucks coffee, a quick meal, a trinket. But if you look further ahead, imagine, with that same $20, if placed in the right spot, at the right time, with the right strategy, it could become the seed of financial freedom, where you live off dividend income without having to work tirelessly. Ever thought you needed millions to invest? The truth is, you only need discipline and $20. What's amazing is that you don't need to change your whole life, just the way you use a very small portion of it. $20 a week equals 2.8 cents a day, less than a bubble tea. But the long-term impact of this decision is far from small. It's the beginning of a powerful growth cycle. Cash flow, investment, reinvestment, passive income, freedom. What you need is not more money, but a smart investment system, where each dollar has a purpose, a mission, and keeps generating value. Don't underestimate the small steps, for it's the tiny daily habits that will shape your financial destiny in the next 10, 20, or 30 years. The issue is not how much capital you have, but whether you have a clear, consistent, long-term strategy. The power of $20 a week lies in perseverance. It's a commitment to yourself, a declaration that you will master the game of money, step by step. Start small, but finish big. That's how wise people build sustainable wealth. Decoding dividends. The cash machine without selling shares. Dividends are the profits companies pay to shareholders as long as you own shares. The best part? You don't need to sell the shares. You still hold the underlying asset, and cash keeps flowing into your pocket. This is the concept of income without depletion, income without draining your resources. And the more shares you own, the larger the dividends you receive. It's a reward for patience and the strongest asset growth engine in long-term investing. For example, if you own 100 shares and each share pays $1 a year, you'll earn $100 a year, completely passively. As the company increases its dividend by 10% each year, the next year you'll receive $110, the following year $121, without doing anything more. Most importantly, you don't need to play the buy-sell game to generate profit. Dividends are real, consistent cash flow, and you can live off them. If you build your investment portfolio smartly, focusing on businesses with stable dividend growth. Especially in volatile markets, dividends act as a safety net. While stock prices fluctuate, cash flow remains steady. This provides peace of mind and discipline in investing, preventing panic when the market dips. The more quality stocks you own for the long term, the more you transform from an investor into someone who hires money to work for you. That's when money keeps flowing into your account every quarter, steadily and growing bigger. Overspending. The high cost of image and ego. You can afford the $35,000 car, but do you really need it? Or is it a trophy for your ego? A silent way of saying, I've made it? Many people spend not for value but for validation. They're trading wealth for image, and they don't even realize it. The truth is, every time you overspend beyond necessity, you steal from your future. A $10,000 car gets you from point A to point B, just like the expensive one. But that $25,000 difference? Invested wisely, it could grow into $500,000. Ask yourself, are you buying freedom or just pretending to have it? Financial growth doesn't come from spending more. It comes from keeping more. And what you keep, you must invest. Luxury is not the enemy. Mindless consumption is. The appeal of high-end goods is emotional, not logical. When you buy to impress others, you relinquish your power to people who aren't paying your bills. That upgrade might cost more than money. It might cost you your dreams. Choosing simplicity over show isn't sacrifice, it's strategy. Real success isn't loud. It's quiet, disciplined, and intentional. And often, it's driving an old car while building a net worth that turns into real freedom. Spending smart doesn't mean living poor. It means living with purpose. Every thoughtful decision moves you closer to the life you want, while reckless ones push it further away. Financial maturity is knowing the difference between desire and necessity, and choosing long-term gains over short-term validation. Every time you resist an unnecessary purchase, you're not depriving yourself. You're investing in peace of mind, options, and independence. Don't let society define your worth by what you own. Define it by what you're building. Spend less on appearance, invest more in substance. That's how true wealth is created. Stock selection criteria. The secret to building a cash machine portfolio. For dividends to become a reliable and growing source of income, you can't pick stocks randomly. You need a clear set of criteria, and this is the foundation for building a portfolio of stocks that generates sustainable passive income. Keep in mind that not all stocks with high dividend yields are good. Some stocks offer 10 to 15% dividends but then go bankrupt. What you need are stable stocks. Not only do they pay regularly, but they also increase their dividends over time. The first criterion is dividend yield. This is the ratio between annual dividends and stock price. A good yield typically falls between 2 to 5%. Anything below 1.5% is too low to build cash flow, while above 6% could be a warning sign. The company may be struggling and needs to attract investors. Look for companies with stable yields over several years without fluctuating wildly. Yield should not be sky high, but stable. That's the solid foundation you need to build real financial freedom. The second is dividend growth year over year. A company that increases its dividend by 10% per year is like giving you a raise without you having to work overtime. Look at the compound annual growth rate, the HAR, of dividends. The higher the number, the faster your dividends will grow. Companies like Lowe's and NetEase have dividend growth of nearly 18% per year. After 10 years, your dividends will be many times higher than they were initially, even if the stock price remains the same. The third is the financial stability of the company. Companies in essential sectors like grocery stores, utilities, and warehouses tend to have stable cash flows. Regardless of economic fluctuations, they can maintain or even increase their dividends during a market downturn. This acts as the defensive shield for your portfolio. You don't just need good dividends, you need dividends that are sustainable at all times. Prioritize companies with steady profits, low debt, and strong financial management. Lastly, consider diversification and capital growth. Dividends are a source of income, but stock prices should also rise over time. A good portfolio should not all in on one sector. Mix real estate, ETFs, retail, and technology. ETFs like SCHD offer stability and lower risk, while real estate investments like Cube provide high yields with little competition. Tech stocks like NetEase offer strong growth. A balance of dividends, growth, and stability will turn your portfolio into a three-engine money-making machine. Powerful, durable, and long-term. Analyzing a specific 5-stock portfolio, fueling your cash flow machine. Let's first look at a stock from the unique real estate sector, CubeSmart, specializing in self-storage. During market volatility, people might sell their items, move homes, or relocate offices, but the need for storage remains. With a 4.89% yield and 14.06% dividend growth, Cube provides stable and consistent income. The stock price also increases by 5.87% each year. This is a true dividend cash cow, providing regular cash flow with minimal cyclical risk. If you want diversification but are not skilled at stock picking, SCHD ETF is a strategic choice. This ETF invests in high-quality dividend-paying companies across various sectors like healthcare, consumer goods, and energy. With a yield of 3.53%, dividend growth of 11.4%, and an average stock price increase of 6.23% per year, SCHD offers stability and minimizes portfolio risk. It's a solid foundation for any investor, especially beginners who want to play the long game consistently. Next is Kroger, KR, the grocery retail giant. Even during economic downturns, people still need to buy milk, rice, meat, and vegetables. Essential sector stocks like Kroger provide absolute stability for dividend income. With a yield of 2%, dividend growth of 13.58%, and a stock price increase of 4.8% per year, this stock may not be flashy, but is incredibly practical. It acts as the defensive core in your portfolio, protecting your cash flow during market fluctuations, while still providing steady growth. For long-term growth, Lowe's is a goldmine in the home improvement sector. With a yield of 1.87%, but a dividend growth rate of 17.99% per year, this is a stock you buy today to reap the rewards 10 to 20 years from now. When the real estate market is tough, people tend to renovate homes instead of buying new ones, helping Lowe's grow steadily. Its stock price increases by 12.72% per year, combined with dividends, making Lowe a double growth pillar, both generating income and appreciating in value. Finally, an explosive unknown, NetEase, NTE, the Chinese tech and gaming giant. Not only does this stock provide good dividends to 5.7% yield, but it also offers exceptional growth. Dividends grow at 17.29% per year, and the stock price increases by 17.78% annually. NTE operates in the rapidly growing tech industry and knows how to share profits with shareholders. This is the accelerating arm in your portfolio, delivering breakthroughs while the rest remains stable. In summary, the portfolio includes 5 stocks: Cube, SCHD, KR, LO, NTE, creating a strategic balance of high dividends, sustainable growth, and strong price appreciation. The average dividend yield is 2.97%, the average dividend growth is 14.79%, and the stock price increases by 9.48% per year. This portfolio is chosen not to make you rich overnight, but to take you toward financial freedom through the most sustainable and intelligent route. The power lies in the coordination. Each stock plays a clear role and supports the others, simulating cash flow from $20 a week to $6,085 a month. Now it's time to turn theory into reality. You hold in your hands a powerful financial weapon, $20 per week. It's not a large amount, but with time and a dividend reinvestment strategy, it can become a massive passive income stream. Let's assume you consistently invest $20 a week into the above 5 stock portfolio, with an average dividend yield of 2.97%, dividend growth of 14.79% per year, and a stock price increase of 9.48% per year. The financial picture will change dramatically over time. After 5 years, you will have invested a total of $5,200. But thanks to the power of compound interest, your portfolio will be worth approximately $6,732. At this point, you can start feeling the dividends coming in regularly every quarter. After 10 years, with a total investment of $10,400, your portfolio will be worth nearly $20,000. Annual dividends will also increase significantly. This is when the leverage begins to form. You'll realize that you're no longer dependent on your own money, but money is making money for you regularly every month. After 20 years, with a total investment of $20,800, the portfolio could reach $182,000. And this is when you truly enter the partial financial freedom zone. You can withdraw dividends to cover expenses without selling any shares. The annual dividends will be around $18,000, roughly $1,500 per month. It's enough to cover basic living expenses or relieve work pressure. This is when you realize small discipline today, big freedom tomorrow. And the peak, after 30 years with total capital of $31,200, the portfolio could reach $675,642. Of that, $317,000 comes from stock price appreciation and $357,000 from reinvested dividends. You've not only built an asset of nearly $750,000, but also created passive income exceeding $6,300 a month, the same as many CEOs earn. It's the reward for persistence, strategic thinking, and disciplined action. You don't need to win the lottery, just consistently invest $20 a week and follow the path of the wealthy. Important notes: don't let your dividend dream be shattered. There's a harsh truth: many people quit halfway. Not because they lack money, but because they lack long-term vision. Don't expect results after just a few months. This is a 10, 20, 30-year game. Resist the temptation to spend dividends early or sell shares when the market corrects. Staying disciplined is the only shield that will protect you from fear, greed, and wrong decisions. Avoid stocks with unusually high dividend yields. These are often financial traps. Don't rush into illiquid stocks or those with no history of dividend growth. Also, review your portfolio 1-2 times a year. Rebalance when necessary, but never chase dividend waves. Success in this strategy is not for the impatient, but for those who bravely plant seeds in silence and wait for the harvest. Practical advice: start in 15 minutes. There's no better time to start than right now. The first thing, open a reputable investment account. In the US, you can use Fidelity, Charles Schwab, or Robinhood. In Vietnam, you can use TCBS, VPS, FIDT. Next, set up an automatic $20 a week purchase order, called DCA, dollar cost averaging. Don't worry about picking the wrong time, because time is the factor you control, while the market is not. Choose an ETF like SCHD if you're just starting, or combine it with Cube for higher dividend yield. Then activate DRIP, the automatic dividend reinvestment plan. And just like that, you're in the game. Every week you plant a financial seed, every quarter you reap dividends, and every year your assets grow. This is not a dream, this is a practical action plan, and it only takes 15 minutes to start. In conclusion, you don't need hundreds of thousands to begin your investment journey. All you need is $20 a week and a solid strategy. Dividends are not a fanciful dream, but a real money machine for those who are persistent and visionary. When you plant seeds every week, you're laying the foundation for freedom, a future where money works for you. This journey starts with small actions. But if you begin today, you can transform your entire financial future. You've heard the term compound interest before, maybe in school, maybe on a finance podcast. But what if I told you that most people completely misunderstand it? Compounding isn't just a slow drip of numbers in a savings account. It's a silent, relentless wealth engine. One that multiplies not just your money, but your future. It doesn't scream, it doesn't dazzle. It quietly builds empires. And those who understand it don't chase get-rich-quick schemes. They build freedom. So, what makes compounding truly powerful? And why do most people never harness it? Let's peel back the layers. Compounding isn't just a financial formula. It's a mindset, a belief system, and a quiet revolution happening behind the scenes of real wealth. Yet most people only see the surface. Money growing slowly over time. They think compounding is boring, something for retirees or risk-averse savers. But that's a misconception that could cost decades of freedom. In truth, compounding is a self-fueling machine, a system that creates not only more money, but more income, independence, and control. When harnessed correctly, it doesn't just add, it multiplies, and it can transform your entire financial trajectory. We live in an era where money is created by electronic signals, not by ink or paper. Every single day, billions of new dollars are added to the global economy, not by printing, but by being generated digitally. This isn't magic, it's the natural consequence of a credit-based banking system. One where your account balance isn't backed by gold or even physical cash, but by a promise. A promise that you can access those funds anytime, simply because a bank says so. Many people fail not because they don't invest, but because they break the cycle too soon. They cash out dividends early, they get impatient, they take their eyes off the long term. But the truth is this: the amount you start with matters far less than how long you let it grow. Compounding is about reinvesting, not just money, but discipline. Every reinvested dollar is a building block, and each one strengthens the foundation of your future. When you withdraw too early, you're not just taking money out, you're taking possibility out. This wealth engine doesn't roar, it hums quietly in the background. While others are chasing market noise, you're accumulating strength, one quarter at a time. Every reinvested dividend becomes a snowflake. Given enough time, those snowflakes turn into a snowball, then an avalanche of income. But only if you don't interrupt the process. That's the secret. Compounding rewards the patient, the consistent, the unseen grinders. The ones who plant seeds, walk away, and let time do the heavy lifting. It's not sexy, it's not flashy, but it's how real wealth is built. So the question isn't, how much money do I have? The real question is, what is my money doing for me? Are your dollars sleeping in a savings account? Or are they working overtime to build more income for your future self? Wealth isn't just what you accumulate, it's what you set in motion. And when compounding is in motion, you no longer trade time for money. You trade decisions for freedom. This is not theory, it's a proven path. And the sooner you start, the sooner you escape the cycle of financial survival. Imagine owning a small vending machine. Every quarter it spits out a bit of cash, a dividend. Now instead of pocketing that cash, you use it to buy another vending machine. Next quarter you have 2, then 4, then 10. That's not fantasy. That's the compounding effect of reinvested dividends. Every dollar received isn't a reward to be spent. It's an opportunity to increase your ownership. The real power of investing is when your income starts buying more income. At that point, you've stepped beyond saving. You're building a living, breathing cash flow ecosystem. Here's what most people miss. Dividends aren't a bonus. They're the core engine. Unlike capital gains, which are uncertain and require selling to realize, dividends are cold, hard cash that lands in your account regardless of market direction. Whether the market is booming or crashing, those payments still arrive. And if you're smart, You don't spend them, you reinvest them. Each reinvested dividend becomes a new asset, and every asset becomes a new income stream. This is how you turn a modest investment into a money machine that scales with time. You don't need to be wealthy to benefit from this. You just need to be consistent. Even a stock paying 50 cents per share per quarter seems insignificant until you own hundreds, then thousands of shares. Reinvested steadily, these small checks turn into serious capital. Compounding doesn't require brilliance. It requires patience, it requires action, and most importantly, it requires respect for small beginnings. The mistake is not in starting small. The mistake is in staying small because you failed to reinvest. The path to wealth starts with choosing to treat every dollar as a worker, not a prize. That's the difference between holding money and owning assets. Money just sits there. But assets move, they generate, they grow, they multiply. Dividends allow you to keep your capital intact while still generating income, and then use that income to acquire even more capital. It's a beautiful loop. Your money pays you, and you use that payment to buy more moneymakers. At a certain point, you don't need to contribute new money. The system sustains itself. You're no longer just an investor. You're a builder of financial infrastructure that works around the clock. If compounding is the engine, then time is the fuel that makes it roar. The longer you allow your investments to run undisturbed, the more dramatic the results become. Most people severely underestimate the exponential nature of time in wealth building. Compounding isn't about earning a steady return. It's about stacking those returns on top of one another over and over again. The real magic doesn't happen in year 1 or year 2. It begins to appear in year 10 and explodes by year 20. Time is not your assistant in compounding, it is your accelerator. Let's say your portfolio earns 3% in dividends annually. Not exciting, right? But here's where the magic begins. You reinvest every single dividend. In year 5, that extra income may feel modest, perhaps a couple $100s, but by year 15 it could be several thousand per year. Why? Because your income is compounding, not just your capital. The reinvested dividends buy more shares. Those shares pay more dividends, and the cycle strengthens. Eventually, it reaches a tipping point where your portfolio grows faster than your effort, and your income becomes a force of its own. Most investors sabotage themselves by expecting fireworks too early. They check their accounts weekly, panic during downturns, and forget the math of exponential growth. They pull money out, they stop reinvesting, they change strategies mid-course, and just like that, they reset the clock. Compounding hates interruptions. Every time you stop the process, you don't just lose gains, you lose momentum. The cost isn't short-term volatility. The cost is forfeiting the momentum that only comes from time. In this game, those who hold longest and reinvest consistently always win. Wealth doesn't grow in a straight line. It grows in curves. That's why so many people miss it. We're hardwired to expect linear results. Input equals output. But compounding breaks that rule. For years, your results may look boring. Then one year, they double, then triple, then take on a life of their own. But this only happens if you respect the timeline. You can't rush compounding. You can only protect it. The most valuable investment you can make is not in a stock, ETF, or fund. It's in uninterrupted time. This is why time should be treated like capital. Just as you wouldn't burn through your savings recklessly, you shouldn't squander your compounding years on emotional decisions. Every day you stay invested is a seed planted. And the longer you leave that seed untouched, the more powerful the harvest. Time doesn't just measure your compounding results, it multiplies them. The question isn't, how fast can I grow? The real question is, can I be still long enough to let the growth reveal itself? Patience isn't passive. In compounding, it's everything. Imagine never having to remember to reinvest your dividends because your system does it for you. That's the power of DRIP, Dividend Reinvestment Plan. It's a mechanism that automatically uses your dividends to buy more shares of the same asset without fees, without friction, and without delay. No second guessing, no manual clicks, no emotional interference. DRIP is the ultimate tool for disciplined investors who know that consistency beats cleverness. It allows your portfolio to grow on autopilot, reinvesting every dollar into future earnings. One small setup decision, and you unlock decades of growth with zero ongoing effort. Most investors underestimate the value of tiny reinvestments. They see a $2 dividend and shrug. But with DRIP, that $2 buys partial shares. Those partial shares generate more dividends next quarter, which buy even more. Over time, the machine compounds itself. DRIP turns cents into snowballs. It builds your position gradually, quietly, and relentlessly. And because it's automated, it eliminates the human tendency to interrupt the process. There's no temptation to spend. No, maybe I'll wait for a better time. DRIP makes the best time now, every time. That's how small, consistent actions beat big, inconsistent ones. Even better, DRIPs are built for imperfection. You don't need to time the market. You don't need to pick the next unicorn stock. You simply need to own quality dividend-paying assets and let DRIP do the heavy lifting. It doesn't react to market noise. It doesn't care about headlines. It just executes the system. While others panic and try to time exits, your DRIP just keeps buying at highs, at lows, and everything in between. And that dollar-cost averaging adds stability and efficiency to your compounding journey, turning chaos into calm and noise into growth. This is why so many long-term investors swear by it. DRIP removes complexity. It reduces decision fatigue. It builds wealth through repetition, not revolution. In a world obsessed with quick flips and flashy wins, DRIP stands for something radical. Long-term trust in the process. It's the tortoise in a race full of hares. And we all know how that story ends. When you combine DRIP with time and discipline, you unlock a trifecta of compounding power that outperforms almost everything else. Not overnight, but over and over again. Quietly, consistently, powerfully. Most people don't fail at investing because of bad math. They fail because of bad mindset. Behavioral economics calls it hyperbolic discounting, our tendency to value small, immediate rewards over larger, future ones. It's why someone cashes out a $3 dividend instead of reinvesting it. It's why a 10% short-term gain feels more satisfying than a 10-year plan. But compounding punishes impatience. The longer you delay gratification, the bigger the eventual payout. Unfortunately, most people trade their future wealth for momentary wins. Not because they're incapable, but because they can't see the invisible growth that's happening beneath the surface. We live in a dopamine-driven world. Quick flips, trending stocks, overnight crypto millionaires. Viral success stories condition us to believe that wealth must be loud and explosive. But compounding isn't any of those things. It's subtle, it's boring, it doesn't trend on social media, and that's exactly why it works. While others chase hype, compounding rewards silence. While others jump from one strategy to another, compounding rewards consistency. The greatest investors don't outsmart the market every day. They outweight it. In a culture addicted to speed, slowness becomes your unfair advantage. The tragedy is that people laugh at small dividends. They mock 50 payouts. They dismiss $3 checks. But that $3, reinvested for 20 years, becomes hundreds. The only reason most people don't see it is because they're not wired for exponential thinking. Our brains prefer straight lines, not curves. That's why we're surprised when things start to snowball. But by then, it's often too late, because we gave up too early. What feels insignificant today is compounding in the background. And if you protect that process, one day you'll wake up to a portfolio doing the work for you. But here's the real villain: emotion. When the market dips, fear says sell. When dividends feel too small, pride says spend. When others get rich fast, envy says switch strategies. Emotion interrupts what logic built, and every interruption breaks the compounding chain. That's why systems beat feelings, automated reinvestments beat guesswork, discipline beats brilliance. In the end, your edge isn't how much you know, it's how well you behave. Compounding doesn't require genius. It requires faith, it requires trust in time, and it requires a mindset strong enough to withstand noise and stay loyal to the process. Success in investing isn't about predicting markets. It's about building systems that operate without needing your constant input or emotional validation. A system is a set of small, repeatable actions you automate and trust, even when they feel insignificant. It could be as simple as reinvesting dividends, setting monthly deposits, or ignoring the headlines. These habits may seem boring, but they remove the most dangerous variable from the equation. You. Emotional investors chase highs. Systematic investors build wealth. You don't need to be brilliant. You need to be consistent. Your wealth grows at the speed of your structure. Now contrast that with emotion-based investing. You get excited when prices rise, terrified when they fall. You jump in and out of assets like a frog on a hot plate, always hoping for the next lucky break. But in reality, you're just resetting the clock over and over again. Without a system, every decision becomes reactive. You're at the mercy of news cycles, Twitter trends, and market mood swings. No structure means no compound effect, just scattered wins and frequent losses. And in the world of compounding, breaking momentum is the most expensive mistake of all. The truth is, you don't need a complicated strategy. You need a simple, automated, and repeatable system. Choose strong dividend-paying assets. Turn on DRIP. Set up recurring contributions. Don't touch it. Don't second-guess it. That's it. No genius moves required. A good system will do the thinking for you, the buying for you, and most importantly, the growing for you. It acts as your financial autopilot, immune to stress, FOMO, and ego. Systems don't panic. They persist. And in the long run, persistence wins every time. Ironically, the more boring your system looks, the more powerful it probably is. It won't feel like you're making progress at first. That's the test. The process is slow, invisible, and sometimes discouraging. But stick with it long enough, and you'll hit what every compounding investor dreams of. Escape velocity. That moment when your portfolio grows faster than your contributions. The moment your money works harder than you do. While others chase noise and quick wins, you'll be quietly building a financial engine that won't stop. Because your system is built to last. Real wealth isn't measured by what you can spend today. It's measured by what you can preserve and grow for generations. That's why the ultra-wealthy don't just invest for returns. They invest for repeatable, resilient cash flow. Dividend-paying assets become the lifeblood of their financial ecosystems. Instead of chasing hot stocks or flipping houses, they hold onto income-generating assets and let the cash flow fund their lifestyles and their legacies. The secret? They rarely sell. They use dividends to live, to donate, and to build trust funds. Their capital stays intact. Their income never stops. The power lies in structure. Wealthy families set up systems, trusts, DRIPs, holding companies, all designed to protect and reinvest income without touching principal. That means no capital gains taxes, no mistimed liquidations, no emotional exits. It's not about outsmarting the market. It's about outlasting it. And compounding isn't just part of their strategy. It is the strategy. While the average investor celebrates a good year, the wealthy quietly add another layer to their financial fortress, brick by brick, dividend by dividend. Over time, this creates generational wealth that doesn't just grow, it sustains. What separates being rich from staying rich? Discipline, structure, and long-term thinking. The ultra-wealthy don't rely on luck or flashy plays. They rely on systems that are boring by design, but brilliant in effect. When you use compounding to build assets that pay you forever, you gain more than money. You gain freedom. You gain time. And when structured correctly, you gain the ability to pass that freedom on, without liquidation, without disruption, and often without taxes. This is how wealth is preserved. Not through noise, but through quiet, compounding precision. You don't need genius to build wealth. You need systems, patience, and faith in boring things done consistently. Compounding isn't flashy, it won't go viral, but it builds what quick wins never will: unshakable freedom. The act of clicking reinvest, ignoring noise, and staying the course isn't small, it's revolutionary. In a world obsessed with immediacy, compounding is your rebellion. It's how you rise quietly while others chase loudly. Every dollar reinvested is a statement: I choose freedom over flash. Do that long enough, and one day, the results will speak louder than any hype ever could. Compounding doesn't reward speed. It rewards stillness, structure, and time. While the world chases flashes of success, you now understand a deeper truth. Real wealth is built silently, patiently, and systematically. It's not about how much you start with, it's about whether you protect the process. You now hold the blueprint that the majority ignore. The question is, will you apply it? Will you trust the boring steps that lead to extraordinary freedom? Because the ones who win the long game aren't louder, smarter, or luckier. They're simply the ones who never quit. You're not broke because you're lazy. You're broke because no one taught you the silent money habits destroying your future. You work hard, you save, but the needle never moves. Why? Because wealth isn't just about hustle, it's about habits. In this video, we're exposing 10 financial traps that feel harmless, but are quietly keeping you poor. And more importantly, we'll show you exactly how to escape them. This is your turning point, the moment you stop playing defense and start building real wealth. No fluff, no theory, just powerful shifts that change your life. If you're ready to take control, this is where it begins. The smallest habits decide your richest future. Let's break the first one wide open. Paying yourself last, the invisible habit that destroys wealth. There's one habit most people have, and they don't even realize how destructive it is: paying themselves last. It sounds harmless, but this single habit quietly robs you of your financial future. Each time payday arrives, you think of bills, shopping, dinners, travel. Only when your wallet is nearly empty do you think, "Do I have anything left to save?" That mindset is a silent killer. Wealthy people never treat savings as optional. They pay themselves first. That's not selfish, it's strategic. Your future self deserves a paycheck too, and the sooner you realize that, the faster you escape financial stagnation. Successful people understand a simple truth: your future deserves to be paid first. They treat saving like an essential bill, one that comes before anything else. As soon as income hits their account, they automatically set aside 10, 20%, even more, into investments or savings. No hesitation, no decision-making, because they know if they wait, temptation wins. This is more than a financial habit, it's a system. Automation is the bridge between financial dreams and reality. The difference between surviving and thriving is often just one habit: consistently prioritizing your long-term future over short-term satisfaction. Shifting this mindset breaks the earn, spend, repeat cycle and activates a deeper motivation. You're investing in your freedom. Don't let money slip away unnoticed. Start treating your future self like your most important bill. This is the simplest, most powerful step toward wealth. When you consistently pay yourself first, you signal to your mind and your bank account that your financial destiny matters. And the best part? You don't need to be rich to start. You just need to decide that your goals are no longer negotiable. Wealth begins with intention. And intention begins the moment you pay yourself first. Buy now, pay later, the psychological trap of modern spending. You walk into a store, spot the latest gadget, and the message gleams: "Take it home now, pay later, 0% interest." Sounds amazing? Think again. This is the front door to a dangerous financial trap. Companies offering these deals aren't generous. They're strategic. They understand your impatience. They're betting on your desire for instant gratification. What looks like freedom is really a financial leash. You're not buying with money, you're borrowing with your future. These small, easy purchases silently pile up, dragging you into debt while giving you the illusion of control. It's not convenience, it's consumer manipulation. Buy now, pay later services are masters of psychological warfare. They tap into your dopamine response, the brain's reward chemical that fires when you spend. That phone, those shoes, the weekend getaway, they all feel amazing at the moment. But behind the rush comes hidden fees, missed payments, and interest rates that can climb up to 30%. Suddenly, your casual purchase becomes a long-term burden. And worst of all, you barely noticed it happening. Financial stress builds slowly, disguised as manageable monthly payments. But over time, these habits turn your cash flow into quicksand, and you won't realize it until you're sinking. The solution isn't to stop spending, it's to spend with full awareness. Use debit cards or cash whenever possible. If you can't afford something today, you probably don't need it today. Train your mind to delay gratification and say no now so you can say yes to real freedom later. Don't let flashy marketing and easy credit hijack your future. Every time you resist the impulse to buy on credit, you reclaim your power. It's not about having less, it's about choosing better. Real control begins when you stop borrowing from tomorrow to impress today. Overspending. The high cost of image and ego. You can afford the $35,000 car, but do you really need it? Or is it a trophy for your ego? A silent way of saying, "I've made it." Many people spend not for value but for validation. They're trading wealth for image, and they don't even realize it. The truth is, every time you overspend beyond necessity, you steal from your future. A $10,000 car gets you from point A to point B, just like the expensive one. But that $25,000 difference? Invested wisely, it could grow into $500,000. Ask yourself, are you buying freedom or just pretending to have it? Financial growth doesn't come from spending more. It comes from keeping more. And what you keep, you must invest. Luxury is not the enemy. Mindless consumption is. The appeal of high-end goods is emotional, not logical. When you buy to impress others, you relinquish your power to people who aren't paying your bills. That upgrade might cost more than money. It might cost you your dreams. Choosing simplicity over show isn't sacrifice, it's strategy. Real success isn't loud. It's quiet, disciplined, and intentional. And often, it's driving an old car while building a net worth that turns into real freedom. Spending smart doesn't mean living poor. It means living with purpose. Every thoughtful decision moves you closer to the life you want, while reckless ones push it further away. Financial maturity is knowing the difference between desire and necessity, and choosing long-term gains over short-term validation. Every time you resist an unnecessary purchase, you're not depriving yourself. You're investing in peace of mind, options, and independence. Don't let society define your worth by what you own. Define it by what you're building. Spend less on appearance, invest more in substance. That's how true wealth is created. Saving without investing. Half the formula, all the frustration. Saving money is a great start, but stopping there is a losing strategy. Millions of people work hard, stash away cash, and believe they're being responsible. But saving alone won't build wealth. Why? Because your money is slowly dying in a low-interest account while inflation eats away at its value. You're not making progress, you're standing still. Real wealth requires movement. Saving protects your capital, but investing grows it. If you're only playing defense, you'll never win the game. To build real financial security, you must move beyond hoarding money. You must put it to work. Picture this. You cut coffee, pack lunch, chase every discount. That's admirable, but if you never invest, you're simply collecting crumbs while ignoring the feast. There's a ceiling to how much you can save, but no limit to what you can earn, or what your money can earn. You'll never save your way to freedom. You must grow. And growth only comes when you take risks, learn, and step into opportunity. Don't let your obsession with saving block your potential for wealth. The most powerful money habit isn't frugality, it's the courage to make your money multiply. The winning formula is simple: save to invest, not just to store. Let your money be seed, not storage. Plan it into index funds, stocks, real estate, or personal development. Build income streams, not just piggy banks. The wealthy aren't just better at saving, they're relentless at investing. Stop playing it small with every coupon and start playing it smart with long-term strategy. A frugal life with no investing is survival. An invested life is freedom. Let your money grow roots, spread, and compound into the life you've always wanted. Interrupting compound growth: how to kill the silent wealth engine. Compound interest is the quiet giant of wealth building. It's like a slow-moving machine that prints money, but only for the patient. When left undisturbed, it turns modest sums into fortunes. But many people sabotage this force by making large, untimely withdrawals. Whether it's to buy a fancy car, an oversized house, or fund a luxurious vacation, the result is the same: you reset the machine. And every time you do, you lose not just the money, but the years of growth that money could have produced. Compound interest rewards consistency, not interruption. When you cash out early, you don't just lose capital, you lose momentum. That $30,000 spent on a car today isn't just gone, it's $300,000 gone from your future. Wealth isn't built by big income, but by uninterrupted growth. Historical data is clear. Long-term investments in the stock market far outperform real estate in return percentages. Time and compounding are your greatest allies if you protect them. But if you keep pulling money out for emotional or image-driven purchases, you break the chain and shrink your future possibilities. The cost isn't in what you buy, it's in what you never grow. That doesn't mean you shouldn't enjoy life or buy a home. It means timing matters. Delay big purchases until your assets can cover them without draining your growth engine. Protect your compounding at all costs. It's your silent employee, working day and night, growing your net worth even while you sleep. Don't fire it too soon. Let your investments run, uninterrupted. The longer you leave them untouched, the louder the compounding speaks, and the more powerful your financial position becomes. Compound growth is slow to start, but unstoppable when respected. Interrupting compound growth: how to kill the silent wealth engine. Compound interest is the quiet giant of wealth building. It's like a slow-moving machine that prints money, but only for the patient. When left undisturbed, it turns modest sums into fortunes. But many people sabotage this force by making large, untimely withdrawals. Whether it's to buy a fancy car, an oversized house, or fund a luxurious vacation, the result is the same: you reset the machine. And every time you do, you lose not just the money, but the years of growth that money could have produced. Compound interest rewards consistency, not interruption. When you cash out early, you don't just lose capital, you lose momentum. That $30,000 spent on a car today isn't just gone, it's $300,000 gone from your future. Wealth isn't built by big income, but by uninterrupted growth. Historical data is clear. Long-term investments in the stock market far outperform real estate in return percentages. Time and compounding are your greatest allies if you protect them. But if you keep pulling money out for emotional or image-driven purchases, you break the chain and shrink your future possibilities. The cost isn't in what you buy, it's in what you never grow. That doesn't mean you shouldn't enjoy life or buy a home. It means timing matters. Delay big purchases until your assets can cover them without draining your growth engine. Protect your compounding at all costs. It's your silent employee, working day and night, growing your net worth even while you sleep. Don't fire it too soon. Let your investments run, uninterrupted. The longer you leave them untouched, the louder the compounding speaks, and the more powerful your financial position becomes. Compound growth is slow to start, but unstoppable when respected. Not tracking your finances, the leaky bucket that drowns wealth. You work hard, get paid regularly, yet your bank account never seems to grow. Why? Because you're pouring water into a bucket with holes, and you don't even realize it. Not tracking your spending is one of the biggest reasons people stay broke, despite a steady income. You might know how much you earn, but do you know how much you spend on coffee, takeout, subscriptions, or impulse buys? It's the small leaks that sink the ship. If you don't measure it, you can't manage it. Awareness is the first step to taking control of your money and your future. The golden rule of personal growth applies to money too. What gets measured gets managed. Start small. Track every single expense for 30 days. You'll be shocked at how much is disappearing on things that don't matter. You don't need to cut everything. Just eliminate the top 20% of waste, and you'll find hundreds or thousands of dollars freed up each year. Apps, spreadsheets, even a notebook, use whatever works. The point isn't the tool, it's the commitment to clarity. Money is a game of awareness before it's a game of skill. See where your money goes, and you'll finally start steering it. Tracking your finances isn't about restriction, it's about revelation. You're not punishing yourself, you're protecting yourself. Every dollar you reclaim from unconscious spending is a dollar you can invest in freedom, options, and peace. Most people don't have an income problem, they have a visibility problem. Once you shine light on your habits, you'll find hidden wealth waiting to be redirected. Small leaks left unchecked become floods. But with attention and discipline, you can patch the holes and fill the bucket. Wealth doesn't begin with income, it begins with awareness. Keeping up with others, the silent killer of financial peace. You were perfectly happy with your old phone, until your friend posted their shiny new upgrade on Instagram. Suddenly, yours feels outdated. You didn't change, your perception did. Welcome to the trap of comparison. It pushes you to spend not for need, but for validation. Social media has turned our finances into a public scoreboard, and far too many are going broke trying to look rich. The problem? You're comparing your behind the scenes to someone else's highlight reel, and the price isn't just your money, it's your peace, your focus, and your progress. Comparison doesn't inspire, it steals. Comparison kills contentment. We live in a world where everyone shares their most glamorous, curated moments, and you measure them against your reality. The bills, the stress, the grind. It's a losing game. No matter how much you earn or own, there's always someone with more. But chasing them will cost you everything. Financial peace comes not from excess, but but from clarity. When you stop chasing other people's milestones, you start hitting your own. Let others flex for likes. You build for legacy. Real wealth isn't found on timelines, it's found in intention, consistency, and freedom. Redirect your focus inward. The only comparison that matters is who you were yesterday versus who you are today. Track your progress, not someone else's possessions. Invest in your health, skills, and purpose, not image. Every time you choose growth over ego, you take back control. Stop letting strangers on the internet dictate your spending. Instead, define success by fulfillment, not flash. The less you compare, the freer you feel. And ironically, the moment you stop trying to look rich, you start building real, lasting wealth. Comparison is a thief. Cut it off and take your power back. Tax ignorance, the largest expense you're not managing. There's a silent expense draining your wealth every year. Taxes. Most people obsess over saving on coffee, but ignore the fact that taxes will cost them more than any luxury ever could. It's not about avoiding taxes illegally, it's about optimizing them legally and intelligently. Those who win the wealth game don't just earn more, they keep more. And they do that by understanding tax laws, utilizing retirement accounts, holding investments longer, and offsetting gains with losses. If you ignore taxes, you're handing a large portion of your wealth to the government without question. It's time to stop being passive and start being strategic. You don't need to become a tax expert, but you do need to get proactive. Learn the basics, automate smart moves, and build systems that minimize what you owe over time. Use tax-advantaged accounts, harvest losses where appropriate, and hold investments long enough to benefit from lower capital gains rates. This is not about paranoia, it's about protection. Every dollar you save in taxes is a dollar that can grow, compound, and serve your bigger financial vision. The rich aren't smarter, they're more informed. Don't let ignorance be expensive. Let knowledge be your shield. Lifestyle inflation, richer income, same struggle. You're earning more than ever, yet somehow you're not any wealthier. Why? Because as your income rises, so do your expenses. This is the trap of lifestyle inflation. New gadgets, fancier dinners, upgraded vacations. You feel like you're leveling up, but your savings remain the same, or worse. You've traded financial progress for surface-level upgrades. You're still living paycheck to paycheck, just in better clothes. The problem isn't how much you earn, it's how much you keep. And until you fix that equation, no raise will ever be enough. The illusion of wealth will always outpace its reality. True wealth builders maintain one sacred rule. Save a fixed percentage no matter how high their income grows. 10% of $3,000 and 10% of $30,000 are both powerful because they scale with discipline, not desire. Don't let your income become an excuse to overspend. Let it be a tool to accelerate your freedom. Spend intentionally, not impulsively. Upgrade your future before you upgrade your lifestyle. The world rewards flashy spenders, but the universe honors quiet builders. And if you resist lifestyle inflation, you'll create something far more valuable than luxury. Peace of mind, optionality, and lasting financial power. In conclusion, mastering money starts with mastering yourself. Financial freedom doesn't come from luck, it comes from discipline. These 10 habits aren't just money mistakes, they're mindset traps. But the good news? You can break every one of them. You don't need a bigger paycheck, you need a better strategy. Pay yourself first. Invest early. Spend with purpose. Track your habits, and most of all, play your own game, not someone else's. Wealth isn't built overnight. It's built daily, in small, conscious choices. You're not stuck. You're one decision away from a different path. Start now. Start small. But start, because the longer you wait, the more expensive it becomes. Control your habits, and you'll control your future. You might think money is printed, stored, and moved around like physical goods, but the truth is far more astonishing. Most of the money in our economy isn't printed at all. It's created with a few keystrokes, conjured into existence by banks, and backed not by gold, but by trust. In this video, we'll uncover the hidden mechanics behind how money is truly made, who controls its creation, and why it affects everything from your debt to global inequality. This is a story of power, promise, and possibility, one that will change how you see the numbers in your bank account forever. And now, let's pull back the curtain and step into the hidden world where money is born, moves, and reshapes civilization. Have you ever stared at the numbers in your bank account and asked yourself, where does this money actually come from? The truth is, the majority of money we use today isn't printed by machines. It doesn't sit in safes, nor is it transported in armored trucks. It exists as digital digits on a screen, typed into being by a system that appears simple, yet conceals an immense financial mechanism beneath. We live in an era where money is created by electronic signals, not by ink or paper. Every single day, billions of new dollars are added to the global economy, not by printing, but by being generated digitally. This isn't magic. It's the natural consequence of a credit-based banking system, one where your account balance isn't backed by gold or even physical cash, but by a promise. A promise that you can access those funds anytime, simply because a bank says so. And that is both a marvel and a concern. When money is no longer tied to physical limits, its power and its risk grow exponentially. Because now, value is not defined by gold mines, but by market confidence, consumer behavior, and monetary policy. Digital money has become the invisible lifeblood of the modern economy. But that raises a critical question: who controls its flow, and for what purpose? Long before money existed, humans exchanged goods and services not through currency, but through trust. Imagine a farmer in need of a tool, but with no crops yet to trade. He promises the toolmaker food after harvest. The toolmaker agrees, not because of any legal contract, but because he trusts the farmer. That promise becomes the first currency, a belief in future value. At the heart of every transaction was trust, a simple yet powerful force that enabled society to function without coins, bills, or banks. As communities grew and exchanges became more frequent, people needed a better system. Bartering random goods wasn't scalable or efficient, so they began using universally valued items, things everyone needed, like salt, cattle, or grain. These weren't just goods, they were early forms of money. Each carried intrinsic value and was accepted widely. Crucially, these items required labor and time to produce, giving them real economic weight. They weren't just tokens, they represented effort, scarcity, and survival. Still, these primitive currencies were bulky and hard to transport. Carrying sacks of salt or herding cattle wasn't exactly ideal. Enter gold and silver. These metals were rare, durable, and could be divided easily. They didn't decay, were easy to store, and became universally trusted. From Asia to Europe, gold was gold. It needed no translation, no explanation. It became the first global symbol of value, an anchor of trust that transcended borders and culture. And from that point on, money began to detach from physical goods. People no longer needed the thing itself, just a symbol of its worth. Notes, promises, and eventually digital entries replaced tangible assets. But the core remained unchanged: belief. A belief that what you hold, paper, coin, or code, has value because everyone else agrees it does. In essence, modern money is no longer just about what you have, it's about what others believe it means. When you walk into a bank and get approved for a loan, something remarkable happens. New money is created on the spot. No vault is opened. No existing funds are transferred from one account to another. Instead, the bank simply types numbers into their system. Voila, the money exists. This is not an illusion. It's a fundamental process in modern banking. Money brought to life by keystrokes and promises. The system doesn't require gold or physical bills, just a borrower, a lender, and a leap of faith. Contrary to popular belief, banks aren't just places where money is stored. Your account balance isn't a pile of cash waiting for withdrawal. It's a digital IOU. A promise that the bank will honor your request when you need it. But when a bank issues a loan, it doesn't pull that cash from someone else's deposit. It simply creates the loan out of thin air, an entry in a ledger, backed by your obligation to repay it with interest. This is how new money is born. Through debt. From a single loan, money begins to ripple through the economy. You buy a car, the dealership pays its employees, the employees spend their wages. That money flows to grocery stores, landlords, service providers. A chain reaction begins, all from one transaction. Each step generates more productivity, more opportunity. The economy grows not because someone saved up coins, but because someone borrowed wisely. In this way, loans fuel the real economy, generating value from potential. Yet there's a catch. If everyone demanded their deposits in cash at once, banks would collapse. That's because the money they have is mostly digital. existing only as long as people believe in the system. This vulnerability, known as a bank run, has shaken nations. The system functions only if we trust that most people won't panic at the same time. It's a fragile but powerful consensus, and it underpins the entire financial architecture of the modern world. Banks are not just middlemen, they are modern-day alchemists. They turn promises into purchasing power. They convert needs into circulating value. When you understand this, you realize that money doesn't come from labor or minds alone. It comes from contracts, credibility, and creativity. In today's world, value is not merely extracted, it's synthesized. Debt isn't just a burden, it's the primary engine of monetary expansion. And the power to create money is one of the most profound forces shaping civilization today. When a bank creates money through a loan, that money doesn't sit still, it moves. A person takes out a loan to buy a car. The car dealership receives that money and pays its employees. Those employees use their wages to buy groceries, pay rent, or go to the doctor. Each transaction triggers another. What started as a digital entry in one account becomes a chain of productivity, fueling business, sustaining jobs, and circulating value throughout the economy. Money, when in motion, becomes the lifeblood of society's progress. Money by itself holds no power unless it's used. A stack of cash hidden in a vault contributes nothing. But when it's spent, invested, or loaned, it sets industries in motion. That's why modern economies don't thrive by hoarding. They grow through flow. Every exchange is more than just movement of capital. It's the conversion of money into value, effort into outcome. Like gasoline in an engine, money must be burned in productive cycles to generate momentum. Idle money is wasted potential. However, not all money flows are equal. When loans are used for speculation, buying properties to flip, hoarding assets, or chasing hype, they don't generate real goods or services. Instead, they inflate prices and widen inequality. This misdirection of credit leads to bubbles, instability, and artificial prosperity. For money to fulfill its true function, it must fuel the real economy, industries that create, build, and serve. It's not just about movement, it's about meaningful movement. We must understand, money is a tool, not the destination. When channeled purposefully, it enables innovation, empowers people, and lifts communities. When misused, it breeds fragility and distortion. Whether it becomes fuel or fire depends on intent and design. Every loan, every dollar circulating through society carries within it the seed of progress, or the spark of imbalance. What we do with money determines whether our economy grows stronger or collapses under its own illusions. When governments need money beyond their tax revenues, they don't simply print more, they issue bonds. These bonds are essentially IOUs, promises to repay borrowed money with interest. Who buys them? Banks, corporations, wealthy investors, and even foreign countries. In doing so, they lend real capital to the government in exchange for these promises. And with those funds, governments finance everything from infrastructure to healthcare, from military to welfare. But behind every new school or road built lies a debt contract signed with unseen hands. Once the government spends this borrowed money, it flows back into the economy through contractors, salaries, suppliers. These recipients spend their income creating jobs, goods, and more transactions. But there's a catch. To repay the bonds, governments rely on tax revenues, your money. What began as an economic boost eventually becomes a financial burden for citizens. The public often benefits in the short term but ends up footing the bill in the long run, often without realizing who the real lenders were. Debt isn't inherently bad, it can be a catalyst for progress when used wisely. If borrowed money builds universities, renewable energy systems, or public transit, it yields returns that outweigh the costs. But if it's used to cover bloated bureaucracies or short-term political promises, the result is wasteful debt with little lasting value. The issue is not borrowing, but borrowing without vision. Interest compounds, and soon, governments spend more servicing debt than investing in their people. That's when debt becomes a silent thief of opportunity. Worse still, when tax revenues fall short, governments issue more bonds to pay off old ones, borrowing from Peter to pay Paul. This debt spiral grows deeper with every cycle. Developed nations may weather the storm thanks to global trust, but emerging economies often face collapse when confidence vanishes. A society that blindly trusts its leaders to handle the money without question becomes vulnerable to long-term decay, masked as temporary relief. The true creditors of a nation aren't always bankers or hedge funds. They're its people and the generations that follow. Every bond is a promise written on the backs of tomorrow's taxpayers. That's why fiscal responsibility isn't just a financial matter, it's an ethical one. The power to borrow is the power to shape destinies. Whether we use that power to build a brighter future or to mortgage it depends on how well we understand the stakes. In the end, debt is not just numbers on a balance sheet, it's a mirror of our collective priorities. Inflation occurs when the amount of money in an economy grows faster than the goods and services available to buy. If more dollars chase the same number of products, prices inevitably rise. It's simple supply and demand, but with far-reaching consequences. Adding money to the system doesn't automatically create more value. Without matching productivity, each new dollar decreases the purchasing power of the one before. Inflation, in this sense, is a hidden tax that erodes your savings, reduces your income's real worth, and silently redistributes wealth. However, not all inflation is harmful. A modest, controlled inflation rate can actually boost economic momentum. When people expect prices to rise slightly, they tend to spend and invest sooner, which energizes businesses and job creation. That's why many central banks target a small inflation rate, typically around 2%. But once inflation spirals out of control, fueled by reckless spending or unchecked monetary creation, it undermines economic stability. When people lose faith in the currency, they stop spending, saving, or investing, and chaos follows. This is why central banks exist, to manage inflation through interest rates and monetary supply. In the past, banks could only lend a fraction of the cash they held in reserves. But now, with fractional reserve banking and digital money creation, they can generate nearly unlimited credit if they meet minimum liquidity requirements. And if reserves run low, they simply borrow from the central bank. This raises a disturbing question. Who, if anyone, is truly controlling the money spigot? If printing money is so easy, why can't governments eliminate poverty with a few keystrokes? The answer lies in confidence. Currency derives its power from collective belief. Once that belief cracks, when people think money will keep losing value, they abandon it. That's when hyperinflation begins, and history has shown how devastating that can be. The lesson is clear. The value of money isn't just about quantity, but credibility. Without trust, even trillions are worth nothing. What if banks created money not just to fuel consumption, but to build a better world? Imagine a system where new money flowed not into speculation or luxury, but into education, healthcare, clean energy, and groundbreaking research. Each dollar would be a seed, planted with purpose to grow long-term societal wealth. Instead of igniting short-term demand, this type of credit would expand productivity, reduce inequality, and foster true human progress. Ethical money creation isn't fantasy, it's a decision, a design, a direction. Today, most new money is funneled into real estate, stock markets, and consumer debt. These sectors can generate quick returns, but often produce little lasting value. The problem isn't just economic, it's moral. We've built a financial system that rewards short-term profit over collective well-being. But what if every dollar created had to answer a question? Whom does this serve? If our credit system prioritized social return over speculation, we could transform money from a tool of accumulation into an engine of empowerment. There are already glimpses of a better path. Ethical banks, community lenders, and decentralized finance, DeFi platforms, are challenging traditional norms. They focus on funding sustainable agriculture, small businesses, clean technology, and affordable housing. These institutions operate transparently, cut out harmful intermediaries, and give power back to local economies. Though small in scale today, their impact is growing, and their message is loud. We don't have to accept the status quo. We can reimagine how money flows. Money is more than a medium of exchange. It's a reflection of what we value as a society. If we create money for consumption and competition, we get inflation and inequality. But if we create it for creativity, community, and collective resilience, we build a civilization worth inheriting. Changing how money is created may be the most powerful act of redesigning the future. It requires bold policymakers, conscious bankers, and informed citizens. But it starts with asking the right question. Is our money funding a world we're proud of? The final truth is this: money is not neutral. It shapes behavior, priorities, and outcomes. It is a silent architect of civilization. And because it is human-made, it can be human-remade. Just as we engineered money to serve trade, we can now engineer it to serve life. A financial system rooted in ethics, impact, and purpose isn't just possible, it's necessary. If we dare to dream, we can design a world where every dollar created becomes a force for good. We live within a system where money is no longer coins or paper. It's belief, power, and vision. Once you understand how money is truly created, not from printing presses, but from debt, trust, and digital code, you're no longer just a player in the economy. You become a conscious architect within it. The real question isn't how much money exists, but why does this money exist, and where is it flowing? If we want a more just, innovative, and resilient world, we must reimagine money's purpose. We must demand that money serve people, not the other way around. Because in the end, money doesn't just shape our economy, it shapes our destiny, and we have the power to shape money itself.
Government borrowing is the biggest issue in finance today.
Governments around the world are addicted to debt.
The sovereign debt levels globally have just grown exponentially.
In the case of the developed countries, the average ratio of public debt to GDP is now back to where it was in 1945. That's rather striking.
It's politically impossible to solve.
Exploding debt is a real worry. If you're an investor, you start wondering what's going to happen and whether there's going to be debt default.
The music stops when you get a major crisis.
The big question is, at what point does the bond market break?
We just don't want the bond yield to get up to a point where it crushes the economy, because then the bond vigilantes will have taken their vengeance.
A determined central bank can always override any market pressure.
I think bond investors should be terrified. Let's face it, the world is addicted to debt. Pretty much every country, okay, leaving Germany aside, has very large amounts of government borrowing.
We've started to take it as so normal now that governments borrow enormous amounts of money relative to their GDP.
The US, Japan, Canada, Italy, France, all of these countries have very high debt levels by historical standards.
Wherever you look, you see problems of government debt or deficit. The US, where the deficit is about 7% of GDP. China also has a very large deficit.
It's a playbook that we've seen going back at least to the global financial crisis. You borrow your way out of trouble, and the way that you pay for that borrowing is more borrowing. And we don't seem to have a way out of this cycle at the moment, at least in some of the biggest economies in the world.
In the case of the developed countries, the average ratio of public debt to GDP is now back to where it was in 1945. That's rather striking. A great deal of this has to do with huge shocks.
So the global financial crisis, then we had COVID, then we had war in Europe. And each time, governments have found, quite correctly, they need to be, as it were, the insurers of last resort.
Following COVID, we had this global spike in inflation, interest rates going through the roof. That means much, much more expensive debt servicing costs, debt interest costs for government.
Debt to GDP levels are roughly 100%, so the same amount of debt as these economies produce every year. The projections are they rise, and rise, to the point where it gets a bit explosive.
My name is Olivier Blanchard. I've been a professor at MIT all my life, but I took a leave to go to the IMF. I joined in 2008. I had to deal with a global financial crisis and then the euro crisis. There's a number of countries which are addicted to that, and I think the disease can hit any country at any time.
I'm Ray Dalio. I'm the founder of Bridgewater Associates, the largest hedge fund in the world. I'm a global macro investor. When debts accumulate and interest payments accumulate, the debt service payments squeeze other spending. And it's a particular problem when there's a need to borrow money in order to make debt service payments, and the spiral begins.
Bonds are effectively an IOU. It's a way that the government can say to an investor, okay, you lend me this amount of money for this amount of time, and I will give it back to you after that amount of time. And in the interim, I will pay you interest payments called coupons. Now, because there are loads of different bonds, they've all got different maturities, they've all got different coupons attached to them, it can be a little bit difficult to compare apples with apples. So to do that, what we do is compare the yields that are available on bonds. Yields go up when prices go down. What governments generally don't want is for yields to go up too quickly or too fast, because that jacks up borrowing costs for everybody around the country. That's why you need a good bedrock of support, of buying support for bonds.
One man's debts are another man's assets. So in order to hold the debt, it has to be attractive. Then there is what some people call the debt death spiral, which means that there's selling of debt when there's worry about that.
People have been warning that this is getting out of control. That drumbeat is definitely getting louder now. We have seen the odd episode where it's looked like investors are saying, we're not buying any more of your bonds. That's when people start to get really jumpy.
I'm Karen Ward. I'm the Chief Market Strategist at JP Morgan Asset Management. So my job is to advise clients on what's going on around the world and help them make the best investment decisions. The level of government borrowing is certainly one of the top questions I get asked amongst clients today. Government debt is supposed to be our safe haven asset. It's supposed to be the bedrock of our portfolio. It's supposed to be the boring bit.
I'm Greg Peters, Co-Chief Investment Officer of PGIM Fixed Income. From a bond investing standpoint, what I worry about is inflation, right? And so inflation on the rise is just so difficult from an overall portfolio standpoint to protect yourself.
Bonds hate inflation. It's like kryptonite for them. They just can't live with it because it eats into their returns.
In a world where we're also being met with inflation shocks, then the role of government bonds as that safe haven diversifier that many investors look to isn't quite so clear.
There are times when, an increase in debt is completely justified. Wars, or preparing for wars, or COVID. These are cases where you have to spend more. What we have seen in many countries is not that. It's basically just tomorrow is another day type behavior.
The world has been addicted to debt because debt has been for free. So we're coming out of this zero negative interest rate world where there's been nothing but encouraging taking on more debt.
I'm Stephanie Kelton, and I'm a professor of economics and public policy at Stony Brook University. I do a lot of public speaking, finance, hedge fund, investment bank. That's my crowd. I can poll them before I go in and say, how many people think we should be reducing budget deficits? Almost every hand goes up. How many people are worried about the national debt? Almost every hand goes up. When I put this graph up, everything changes. This is the United States of America. The government has been running deficits for virtually my entire life. But look up, and they see surpluses in the rest of the world and surpluses in the US private sector. If you want to eliminate the government deficit, you're going to erase all of the other surpluses because the one is creating the other. The government deficit is doing something very useful, which is creating a surplus, allowing the rest of us to net save. Their red ink is our black ink.
My name is Russell Napier, an advisor to investment institutions. One of my joys is also to be the keeper of the Library of Mistakes, a business and financial history library here in Edinburgh. There is an issue with there being too much borrowing in the government sector, but it has to be seen in conjunction with too much borrowing in the private sector. If we lived in a country where government debt to GDP was high, but the private sector debt to GDP was low, then the consequences of this government debt addiction would actually be quite different.
Private borrowing, private debt and private markets are, in my view, just as big a problem. Really big private busts cause explosion of government debt. After the financial crisis, until the pandemic, and really a year or two after the pandemic, all we were worried about was inadequate demand and deflation. That was a world in which monetary policy was aggressively stimulative. Inflation has come back and the inflationary pressures seem quite strong.
When you're dealing with government's requirements in the political system, there's a desire for spending. When you get credit and you can hand things out on credit, at that time, it's better. Credit produces debt.
One of the ways we tried to deal with that situation for the last decade was to try and cut back on other areas of spending. But that's actually left us with a new problem. We haven't been committing enough to public services, public infrastructure. And you can see that the pressure is on governments around the West to, if you like, make up for the lost spending that happened during the decade of austerity.
You've got all these pressures which are building up. We've got quite weak growth, so you don't have hugely rapidly growing tax revenues.
You're gambling with World War III.
A more uncertain global security world, defence is going to become more of a priority, not less. An ageing population. There's a green transition. Now, a lot of that needs some sort of public support to make it happen faster. And we're likely to see interest rates much higher than they were before, and that adds an additional burden.
We've now got to the point where it's pretty normal for governments to borrow on a kind of crisis pace every year.
In a world of low inflation, you can get away with this. Bond investors will fund you and fund you and fund you. But in a world where it is not likely that inflation stays low, that is when time is called upon the whole thing. Supply and demand are running headlong into each other.
The bond market was the ultimate arbiter, right, of fiscal responsibility. The bond vigilantes, so to speak, step in and actually focus the mind of politicians.
I'm Ed Yardeni. I'm the president of Yardeni Research, focusing on global macroeconomic and financial markets. I've been doing this for over 45 years. And I first wrote about the bond vigilantes in July of 1983. And during the 1970s, bond investors got killed. Inflation soared and bond yields went up dramatically. And I argued that if the fiscal and monetary authorities were not going to maintain discipline, that the bond vigilantes would take over and they would push bond yields up to levels that could slow the economy down and bring inflation down. We just don't want the bond yield to get up to a point where it crushes the economy, because then the bond vigilantes really will have taken their vengeance.
We've seen all this rise in debt without the bond vigilantes stopping it, with a few exceptions. So what did we see in 2022 in the UK? The bond markets decided that the Liz Truss government didn't have a clue.
Our gift to the world is showing everyone what can go wrong if you push the bond market too far.
Mr. Speaker, I am a fighter and not a quitter.
Bond investors talk about Liz Truss moments. We all remember back end of 2022, Liz Truss and her Chancellor Kwasi Kwarteng effectively blew up the gilts market. Prices fell incredibly quickly, triggered a lot more very aggressive selling, and it all got out of hand very quickly, and it took the Bank of England to steady the ship. Governments around the world live in dread of doing that to their bond markets, because immediately you could see in the UK during that episode that borrowing costs went through the roof, people's mortgage costs went through the roof. Bond markets matter in real life because it really hits the average household in the pocket pretty hard.
The UK is front and center in many respects around the concerns of debt sustainability.
So I don't think it's particularly a fiscal credibility problem here in the UK. There are questions over the long-term growth prospects here.
We don't want to get this out of proportion. There isn't a UK markets crisis happening right now, like what we saw 2 or 3 years ago with Liz Truss.
This government inherited quite a relatively tight fiscal position. Maintaining fiscal tightness is going to be very difficult because the pressures for spending are just so strong.
The big question is, when the big boy here, the US, which has the biggest deficits, has completely unsustainable debt profiles, when do the bond vigilantes take against the US?
The US is really at the heart of this entire issue. It's the linchpin of the global economy. It's bond market is worth more than $20 trillion. It has a bigger deficit than most Western countries. And then you have Donald Trump coming into office.
Worst case, you're looking at 10 years forward, 160% debt to GDP. That is an eye-popping, staggering number.
The US federal government spent $880 billion on debt interest last year. That's 4 times the level of a decade ago. And it's more than they spend on the military, almost as much as they spend on health. If the way that you pay for debt is to issue more debt, you're vulnerable to a rise in interest rates, and that's exactly what's happened.
It's approaching 25% of all revenues just to pay back the debt, and that is the classic debt trap, right? It's a hole that you can't dig out of, and you can't inflate your way out.
Well, the US is running an enormous deficit, about 6% of GDP, which in peacetime at full employment, remember, is extraordinary. I mean, it's absolutely enormous. And the trajectory for US debt, if you look at standard forecasts, I mean, it's very, very disturbing. Since it's the most important country with the most important currency.
The projected amount of debt that has to be sold, which equals the deficit, is 7.5% of GDP. And at existing interest rates, that raises also debt service a lot. So it's right at that precipice. I think the way that you address this issue is you make a bipartisan, cross-party lines commitment to 3% of GDP.
People are so conditioned to hear the word deficit and think it's a pejorative. And what I think we have is a linguistic problem. We're using words like deficit and debt to describe things that are really quite benign. When people say they're very worried about the government deficit, what they're saying is, I'm very worried about the financial surplus that's in the non-government part of the economy. Call it the net contribution instead of the deficit. Call it the cumulative net contribution instead of the debt. The temperature would come down a lot if people understood that the thing we're fighting over is our financial surplus and our savings account.
The Trump administration, once they realized that they were going to go into the White House, they had to at least make some effort to satisfy the bond vigilantes. And so suddenly we have the DOGE department, the Department of Government Efficiency.
And they're also going to address the deficit. So we've got a $2 trillion deficit. And if we don't do something about this deficit, the country's going bankrupt.
Maybe this Department of Government Efficiency, which Musk is supposed to head, will somehow find enormous savings which will be enacted. I'm very, very skeptical that there's anything there which will be big enough to offset likely tax cuts.
Elon Musk was kind of, I think it was asked during the campaign, how much do you expect to cut off from the deficit? And he right away blurted out $2 trillion. Even he's backed off on that.
I'm skeptical that Musk will be able to reduce spending sufficiently to decrease the deficit by any substantial amount. It would take some hiccup in bond markets, in the treasury market, to actually lead Congress to be slightly more responsible.
The US is crucial to the global financial system. The dollar is the world's currency of trade, of cross-border debt. People in other countries, big investors, central banks, they need to hold dollars. That means they need to buy US government debt. It's the benchmark safe asset for the whole world. Now, that has enabled the US government to be more free spending than most others. Maybe the type of crisis that we've seen in the UK or in the Eurozone a decade and a half ago could eventually come to the bond market, the economy that is at the center of all of this.
It could be really the most significant fiscal, monetary problem in the world. And it could trigger destabilizing events in financial markets.
I did see a post from President Trump, 2 words, all caps, balanced budget, with tax cuts and a lot of spending on border and other things. I think it's more likely than not that we'll see large deficits continue.
On the flip side, we've also seen with a country like Japan that you can have very, very high government debt levels for a very long time and really nothing bad happens. The key to Japan's success, if you like, is that their very high debt levels have been accompanied by an economic stagnation where the central bank keeps interest rates very low and also does quantitative easing where it buys up all of the debt. So it doesn't really enter the market.
And you had the currency depreciate by 4% a year. So you lost about 70% relative to US bonds. It's going to be a bad deal.
The bond vigilantes, if we want to be honest, they're the central bankers. A determined central bank can always override any market pressure to move yields higher, as the Bank of Japan has clearly demonstrated.
The unique thing about Japan is that the creditor of the Japanese government is the Japanese people. They've been prepared, and it's mostly the corporate sector, to hold Japanese government debt at zero yields despite inflation. And the Bank of Japan is a highly trusted institution. I wouldn't be surprised if there were problems at some point, but they do have the most trusting and most solvent creditors in the world, namely themselves.
For the most part, this is a Western problem. This is a problem in developed economies. But if you look at a country like China, for example, a lot of people now are drawing parallels between China's economy and Japan's 10, 20, 30 years ago, talking about demographics, aging populations, debt levels going up.
You look at the debt levels in China, it's staggering. And I think that has real implications. It's a closed system. They're not growing in the same way that they have before. The remedies just aren't really available.
You could be seeing a situation there where these kind of existential worries about debt become an issue too.
The Eurozone's public finances are rather stronger than those in the UK or the US or Japan, but the Eurozone's not a cohesive picture by any stretch of the imagination.
Italy is one of the biggest borrowers, if not the biggest borrower in the euro area. France, just politically, has a really difficult time reining in spending.
And in France, there are plenty of issues that we have to confront, including the deficit and the debt. And so I'm involved in those discussions. The debt level is high, but it's increasing, and that's what worries me. I think we have to at least stabilize the ratio of debt to GDP, and that's a big number. I mean, to do this under the best assumptions that I can make, it's 150 billion that we have to find. In the current political environment, that's absolutely impossible. It may well require the kind of crisis which makes people sit down and be willing to accept cuts. And without it, I'm not sure we'll get there.
You've got an additional element here, which is Germany, the poster child for limited spending, limited borrowing, one of the safest and frankly most boring bond markets on earth.
Germany's new chancellor has reached a historic deal to spend hundreds of billions of euros on defence and on infrastructure. Now, this is a huge change. We're talking about an economy that has historically been very reluctant to borrow heavily. So in a sense, Germany is belatedly joining the global debt party.
They need more domestic demand, and the private sector runs a huge surplus in Germany, doesn't generate demand adequately, has to spend a lot more on defence, we all know it. Its growth is very slow, it needs a lot more public sector investment. Investment has been very weak. If you need a defence build-up, you need to borrow. That's what governments are for.
Whilst the rest of the world have been spending, whether that's checks in the post in the US during COVID, huge support for industry, like we've seen in China, supporting its electric vehicles. We haven't seen the same behaviour in Germany, but it's paid the economic price for its prudence. It's really struggling to compete with some of those car producers in China that, thanks to those subsidies, have reached massive economies of scale. The consumer in Germany, not having had those checks in the post, is much more cautious, hasn't been spending.
The investment community has been crying out to Germany to borrow for the last decade and a half. They've been reluctant to do so. Now that they are, as I say, belatedly joining the party, people are assuming this will be great news for the German economy, great news for the European economy.
Debt is not always bad. That's the important thing to remember here.
Italy is a bit different from France. It has a high level of debt, but again, between 100 and 130. What you have is a prime minister who actually is fairly responsible from a fiscal viewpoint. One of the reasons is that a lot of money from Brussels is conditional on good behavior. Italy is behaving fairly well.
The bond vigilantes have never been potentially more powerful simply because there's a lot more debt. Whether the politicians get the message is a whole other story.
We have to get the government deficits down to a level so the debt doesn't rise relative to incomes. If it's not done like that, you will have a high risk of a financial market heart attack.
You just can't say at X%, that's when the bond market's going to wake up. That lack of clarity around an exact number is the problem.
That's the thing that really worries investors because there's nothing they can do to hedge against it or prepare for it.
A big risk here is what we saw in the 70s. The governments that issue debt in their own currency very rarely default. With the Trump administration possibly at war with the Fed, that could look quite plausible in a year or two. And if that happens, then the bond market would certainly break. You get high interest rates, high inflation, and in the end, inflation wipes out the debt, and that should make the investors very worried.
Something's got to give. Either bond investors have got to be convinced somehow to just chew down on returns that they really don't want, or governments have got to massively cut their spending.
Austerity isn't going to happen. It may be a market impulse to go for a debt spiral, but governments would not permit it. These so-called vigilantes are back because they can see a world going forward where there's more inflation. My opinion on the vigilantes is that they will be assassinated. And this is what we did after World War II. We didn't allow the market to determine the price at which the governments would pay for credit. We forced people to buy government bonds, keep those yields at rates that any vigilante would consider obscenely bad value to prevent the debt spiral and the death spiral. Whether we live in democracies or whether we live in dictatorships, the dictation will be to the vigilantes, not the vigilantes dictating to the governments.
There's a real debate between economists. Some people will say the bill is falling due, something bad is going to happen if we don't cut debt soon. Other people will point out that actually government finances are not like household finances. You don't have to pay your bills because you control the money printing machine.
Problem with that is that it's inflationary, so there's no zero-cost way to sort this out.
If you don't like the fact that there's a large and growing treasury market, you could always make the decision to stop issuing more treasuries. It's a policy choice. It's not an economic imperative that the government issue securities to match the deficit each year.
You don't need to get rid of government debt. All you need is to stabilize it at some level that your population and your lenders think is reasonable.
Deficits can be useful when the economy goes down, right? There is a recession. Then it's clearly a good idea to have a larger deficit when times are bad, and a larger surplus when times are good.
Public finances have to be sustainable. The wrong way to get there is have a massive, sudden fiscal shock and tightening. That was the great mistake after the financial crisis with austerity. But we should be sure that they're sustainable and that we should be sure that the public finances support growth.
If you simply take the view, let's borrow as much as we can, then you'll find yourself with this problem in the private sector. Now, there are other people in that camp who say, well, that's really easy because we just fund it by printing more money. Well, there's a long history of how that is disastrous. Now, I know those people will argue that it will not be like that this time. I think any financial historian finds it exceptionally difficult to see how the direct government financing by the central bank is anything but heading to very high levels of inflation. But, big but, there are plenty of savings in the world, and the government's going to manipulate those savings to borrow more money. But it's going to borrow that by forcing people to buy those government bonds. I don't think they take the radical approach that some people recommend of direct funding of the government by the central bank. You don't have to take that risk. The world's full of savings. You can abuse the savers long before you have to abuse the balance sheet of the central bank.
I can't see a way for governments to snap this reliance on debt.
The countries which have large deficits are going to go through tough adjustments. The notion of fiscal rules will come back.
No panics. Panics are the worst thing you can do unless you've got an absolutely overwhelming immediate crisis.
Everybody wants more credit. And politicians particularly like borrowing and spending because the paying back comes in somebody else's term.
And if you can increase spending without increasing taxes and get away with it, that's nirvana. And there's only one problem is, well, how about the bond vigilantes? Maybe they don't want it, and maybe they have the power to stop that.
So there are big debt cycles that go on for 50 or 75 years in which debt is rising relative to the income needed to service that debt. Policymakers need to understand the big debt cycle. Are there limits to debt? What are they like mechanically? Yes, because it will come.
Every government deficit is good for someone. Is it a deficit that is resulting from passing tax cuts that primarily benefit people in the top of the income distribution? That deficit is going to be very good for that cohort of people. Or is it a deficit that is the result of making investments in your healthcare system, your education system, your infrastructure? That can increase the deficit as well and serve a different constituency.
Inflating away the debt by stealth over a period of many, many years may turn out to be the least worst option here, or at least one that allows politicians to avoid making some very, very unpopular decisions. But higher inflation, as we've seen in recent years, is very unpopular and can also lead to governments being thrown out of office.
Inflation has to be unexpected. If inflation is expected, then bond yields go up and actually governments don't improve their debt situation.
I can't imagine a world easily without government debt. Government debt has been a feature of economies for centuries. The modern financial system in the UK was created with the creation of the Bank of England, and that was there to help the government manage its debt. The government is the soundest credit, and it does long-run things. There's nothing wrong with borrowing. It's part of what makes a modern financial system work.
When the tide goes out, that you see who's been swimming naked.
So let's rewind to 2008. You have this huge global financial crisis.
That was due to leverage, too much borrowing, particularly in the US mortgage market.
The result of that was the need for incredible liquidity injections into the financial system.
In the immediate aftermath of the global financial crisis, central banks really had to sit on their hands. Economies globally were so lackluster and the recovery was so slow, and central banks weren't grappling with high inflation. They were grappling with what to do with incredibly low inflation.
And central banks around the world respond to the recession that follows by slashing interest rates, by buying up vast quantities of government debt under their quantitative easing programs.
This was a new thing, really. We saw central banks buying back huge amounts of government bond markets, trillions and trillions of dollars worth of government IOUs ended up being owned by central banks instead of by traditional investors.
And that did set forth a paradigm, if you will, of inexpensive money and a feeling that there was a Fed put below the markets. The Federal Reserve and central banks globally were able to achieve this because there was no inflation.
Financial markets in particular get conditioned to this world where every time something goes wrong, a central bank comes riding to the rescue.
Ever since that point, we've had loose monetary policy with interest rates heading all the way down to zero. If you went back to a couple of years ago, most of the government bond markets of the world had negative yielding government bonds, which is just extraordinary.
Now that existed up until the pandemic hit, and then you had central banks and governments step in pretty aggressively to support the economy while we put the economy into a deep freeze.
The global financial crisis, followed by a Eurozone crisis, followed by COVID, three big things coming in rapid succession. In a way, we've almost forgotten what normal looks like.
There is everything that leads up to COVID and the invasion of Ukraine, and there is everything after.
What's changed in one word? Inflation.
There was a belief that inflation was transitory, that this was caused by supply chain issues during COVID, by a tight labor market because of COVID, and that would recede, and you'd see inflation coming down. The realization by central banks that this was not the case, that inflation was stickier earlier this year, led to this very steep rise in interest rates.
Suddenly you had energy prices going through the roof.
world has changed. The world is different. Inflation is here for the first time in most investors' living.
What we hear from officials is that it's not going back to the way it was anytime soon.
You have inflation for the first time in 40 years, limiting their ability to use monetary policy and inject liquidity in the same way. So as a result, we're seeing a drainage of liquidity globally, higher rates, and a new paradigm.
You can no longer buy up government debt every time there's a wobble in the markets because you need to concentrate on your main mission, which is fighting inflation.
There's so much uncertainty that investors are pulling their money out of the markets into cash as well. So that's further withdrawing liquidity.
The first really big rake that has been stepped on here is in the UK pension sector.
The Bank of England are taking further steps to control inflation.
Let's rewind to September the 23rd. We have a gilt market which is expecting this new government to come out with a package of energy subsidies. What they didn't expect is that the government would pile a load of unfunded tax cuts on top of this, borrowing even more money than the market realised it was going to be. The supply of gilts, the supply of new debt that the UK government has to raise has suddenly gone up.
The UK government bond market, generally on the boring side, it's kind of a rinky-dink little market compared to the US Treasuries market. It got fried.
The market freaked out because essentially the government was saying we need to borrow much more money at a time where it's going to get even more expensive to borrow money. This drove a sharp sell-off in the UK government bond market. The speed and scale of the move in the gilts market was unprecedented, and this is what caused a shock.
If the supply of something goes up, investors respond by selling it. You see UK borrowing costs leap higher on the day of the budget.
It was going to result in the biggest amount of gilt issuance that we've ever seen. The more bonds that are issued, the more that the market has to buy at the lower price that the government will have to sell those at.
Pound crashes to its all-time low against the dollar. Usually higher interest rates would be good for your currency, but we have this sense that the international investment community has lost confidence in UK economic policy making.
And that caused a whole bunch of forced selling in the LDI market.
Liability-driven investing, or LDI, has been at the centre of this. This is a strategy used by certain pension schemes to protect them against big swings in interest rates. The reason that they need to do that is because moves in long-term interest rates mean that their liabilities, the money that they have to pay out to pensioners for decades in the future, swings up and down wildly. Now, one way that they can protect themselves against that is by owning lots of gilts. Gilts, long-term government bonds that will also see wild swings in their prices as long-term interest rates move. That works if you were able to fill your pension portfolio with 100% gilts. In practice, it doesn't work that way. There are shortfalls in the funding of these schemes, so they need to buy riskier assets as well.
The returns that you can get out of bonds have been falling for years. So they think, well, we need to enhance returns. They need to hedge themselves against the risk that bond yields could fall further.
And that's where derivatives come in, that effectively synthetically create the same effect of holding long-term gilts, but using leverage, using borrowed money.
The problem is that if bond yields rise, pension funds have to pay out that money. That can mean that they have to sell assets really quickly.
As gilt yields climbed rapidly in the wake of the budget, that meant that those swap positions moved against the pension funds. The type of moves that are supposed to be only seen once in a generation in the gilt market, we had that happening 3 days in a row.
So when the gilt price fell, the yields rose, and this meant that pension funds faced collateral calls.
They had to raise new cash, and they had to raise it fast.
Selling of UK government bonds meant more selling of government bonds, and it spiraled incredibly quickly, and it very quickly became a threat to financial stability in the UK.
This is a slow-moving industry. These guys are not used to responding to market conditions on a day-by-day basis. LDI was a strategy that was sold to companies as something that you can lock away in the drawer and not think about. It wasn't supposed to be something where pensions trustees and where companies had to think fast about which assets they can liquidate in order to meet margin calls on their collateral positions.
If the Bank of England hadn't stepped in, there would have been this doom loop of asset sales where it becomes a sort of self-fulfilling prophecy, and you sell prices into a falling market and prices keep on falling. And then you risk contagion across other parts of the market.
The Bank of England announces that it's prepared to buy up to £65 billion worth of gilts, of long-term gilts, over the next 13 days, which effectively looks like a return to the days of quantitative easing, precisely at the time when they're trying to back away from policies like that.
The Bank of England had to step in. Something had to give. Ordinary people who pay mortgages could see that the rates on those mortgages were shooting through the roof. Mortgage lenders were pulling out of the market.
It could have developed into a financial crisis.
The LDI dynamic, exposed the stresses that can happen in the system when you have a very sharp rise in interest rates. Loose fiscal policy combined with an inflationary backdrop, very dangerous. And I think the financial markets really forced a coherence in fiscal policy. The Bank of England's response to that was a tactical response, inject liquidity for a moment in time to reverse the quantitative tightening policy they had.
If the Bank of England hadn't stepped in as the market maker of last resort, I think we would have had a Lehman-type event where you had a bunch of UK pensions go bust. Pension funds knew that the Bank of England wasn't going to let them go bankrupt. There was some reticence to unwind their positions, which is why the governor, Andrew Bailey, created this deadline and really stuck to it so that pension funds would have to unwind it rather than just handing it over to the Bank of England and allowing the Bank of England to take the losses.
It was very, very tightly targeted. It wasn't a monetary policy move. They were at pains to point out that, this isn't more easing. This is just us making sure that the system can hold.
Central banks like the Bank of England wear two different hats. One of them is to set monetary policy and control inflation, and the other one is to protect financial stability. Now, for most of the last decade, those two things have worked pretty well hand in hand. When you had no inflation and low interest rates, it was easy to ride to the rescue on financial stability grounds without compromising your monetary policy. With high inflation, you can't do that anymore. Your financial stability function no longer pushes in the same direction as monetary policy.
The question is very much whether this is a very British problem or whether the UK is a taste of things to come.
The crisis that we've seen in the UK pension fund market could be a harbinger of what's to come elsewhere.
When you see rates rise as quickly as they have, often there are things that break.
There are going to be a bunch of market dislocations, and it's going to be central banks that are going to have to step in to paper them over, even as they're trying really hard to fight inflation.
One of the most famous and oft-repeated phrases that you ever hear in financial markets is the famous quote from Warren Buffett. It's only when the tide goes out that you see who's been swimming naked.
It's a great metaphor for where we are now, because as the liquidity is withdrawn, we can see where all the vulnerabilities are because they're going to blow up.
Which investment strategies, which business models no longer work in a world of rising interest rates.
Once all of that lovely liquidity is gone, then you find out what's really at risk.
In a bull market, almost everything goes up and you can't see the problems in the portfolio. It's only when the tide goes out or the markets turn that you see where the issues are or who's got their trunks down.
If you're looking for who's been swimming naked, there's a lot of skinny dippers out there.
The places to look are wherever there's leverage in the system, wherever there's borrowed money. When markets move a long way quickly, people lose money on their leverage positions and they're forced to sell assets in a disorderly way, which exacerbates the moves and creates even wider problems.
After the financial crisis, global regulators did a lot of work to make the banks safer, as a lot of the risk got pushed away from the banking sector into what we call the shadow banking sector. Non-bank players such as hedge funds, private equity, pension funds and asset managers, the unregulated parts of the financial sector. Before the financial crisis, regulators knew that most of the leverage was in the banks. The problem is now we don't really know exactly where the leverage is.
If this can happen to the gilt market, it could happen to the Japanese government bond market. It could happen to the US Treasuries market. We have to be ready for the possibility that bonds just don't work like they used to anymore.
The market dislocations and price moves that we see in global markets over the next year will be as swift and severe as what we saw in the UK with the LDI blow-up. Markets broadly, globally, are very stressed already.
Partly it's driven by a disagreement between governments that want to boost the economy and central banks like the Bank of England who want to slow the economy. And that story is going to replay in other parts of the world, including probably this winter in Europe.
The European Central Bank has to set policy for lots of countries. That means one of the things that they're really worried about is the gaps opening up in bond markets between what it costs different countries to borrow. And this is particularly for countries with weaker economies like Italy or Greece. So far, they've been able to get away with the threat of buying more Italian bonds to stop this happening. But again, they face a similar dilemma to the Bank of England. How do you convince people that you're still committed to fighting inflation and at the same time commit to buy billions of euros of assets in order to stop these cracks opening up in the financial system? The Bank of England certainly sets a precedent for the Fed here. You can imagine a situation where the Fed is forced to intervene to protect market functioning while at the same time they're moving in the opposite direction in order to reach their monetary policy objectives. It's a very difficult tightrope to walk when your financial stability and your monetary policy functions are pulling in different directions. And one of the big worries in the US is the smooth functioning of the market for US Treasuries, which is the world's largest bond market. It's a fundamental part of the world's financial plumbing.
Everything depends on the fate of the US Treasuries market, but there are some real cracks there.
Lots of participants in that market have been complaining that liquidity is getting worse, that it's harder to trade bonds without moving the price, that sometimes it's simply impossible. That's a worrying sign when you're talking about a market that's so fundamental to the global financial system.
The US bond market is the interest rate that sets the global interest rate. Everything that happens to US Treasuries has implications for equity markets, property markets, your mortgage rate. Everything is based on US Treasury bond markets.
As the Federal Reserve moves to tighten monetary policy by raising interest rates and also by winding down its portfolio of Treasuries, people are worried that those problems may get worse and that you may end up in a place where the Treasury market simply isn't functioning.
The Treasury market is hands down the world's most important bond market. So dysfunction in that market is just not going to be tolerated from the Federal Reserve. That being said, there have been cracks. In March 2020, there was this big broad dash for cash as investors panicked in the face of the pandemic.
The nightmare scenario, honestly, is that we get anything like the sort of volatility that we've seen in gilts happen in US Treasuries.
Something similar in the Treasury market is probably a disaster for the global economy.
Bank of America has done a lot of research into these fragilities that it can see occurring in the US Treasuries market. If the Treasuries market fails to trade for a period of time, various credit channels, including corporate, household, and government borrowing and securities and loans, would cease. This could lead to events such as US government debt default, not good, inability to convert treasuries to cash or meet corporate, household, or government obligations globally, the inability to produce benchmarks that form the backbone of the derivatives market, the inability to issue, trade, or hedge debt of corporates, municipalities, insurance companies, banks. I could go on. Potentially one of the biggest risks to financial stability that there has been anywhere since the housing bubble of 2006 to 2007.
We're facing into a recession across developed markets, a slowdown in China, unbelievable geopolitical risk, a war in Europe. I think the flight to safety might be a trend that we'll see over the